You all could give me a little heads up on X. Let me know you guys can hear me. Let me know that you can read the disclaimer. And as soon as I get a few confirmations, I'll begin. Well, good morning. Good morning. Good morning. And it is a good morning. So it's Friday. Thank God it's Friday. And a long work week, putting up with Carl and the rest of his angst. I remember what it was like. I remember. All right. So, real quick, just take a quick look at this. Shush up, old man. You talk too much. The disclaimer here, make sure that you have read that because it's important that you do. Everything that I say here today is obviously my opinion. It's not meant for you to put any money behind it. I am human. Sometimes, I can make mistakes. Sometimes I buy when I mean to short, and sometimes I short when I mean to buy. It's a human thing. It comes up, and anything can come out of my mouth during the live stream, and it may be a mistake. I may misspeak. I may say something that wasn't entirely correct. It's not intentional. I just want to remind you that. This conversation today is obviously, like it always is one sided. You get to have the opportunity to decide whether or not you stay with the stream or turn it off and go do something else. And that's fine. But just real quick, just for housekeeping, so that way you know if it's worth your time. I'm going to cover the dollar index first. I'm going to cover euro dollar, pound dollar. I'm going to cover gold, crude oil, and I'm going to go into the major averages. So that's the Dow Industrial, the Nasdaq, the S&P, and I'm going to look at their counterparties with the CFD markets. So for those that can't trade in our US markets, I'll kind of like bridge the gap for you, in my opinion, as it relates to what I see in the futures market and what that would mean through my perspective with the US 100, US 500, and the Dirty 30 on CFD market. All right, and then I'll show you, because I got a lot of questions about stock trading and how my concepts can be applied to stock trading. So I'll give you some tips and some things that go along with that. I'm going to try to be very succinct, right to the point, because there's a couple things I want to do this morning away from my home. So I can't promise to be with you for a very long time. Usually, I give you a very facetious, you know, it's kind of like a ongoing gag where I'll say I can't be here for a long time, and then I go for a long, long time. Sincerely, I don't have that today. I wanted to do that yesterday, but I just simply couldn't do it. So anyway, as you can see, these are the notations I had from the last time we talked about things. And I've been away, in case you've been wondering. I have been abducted by the people in the van. Just so gullible. Anyway, the point is, I've been away. I did a couple road trips with my wife. We did the entire east coast of the United States. Went all the way up to Maine, all the way down to Mile Zero, Key West, Florida, and now we're getting ready for the holiday. So this will be my last live stream for 2025. I will resume all full analysis and whatnot the first Tuesday of February 2026. I know it seems like a long, long time, but you'll be fine. I promise you'll get through it. All right, so dollar index. We're looking at the daily chart, and you will probably hear me slurp a few times in here because I'm not going to be able to reach for the mute button on my microphone as often as I probably should. But I'm sipping a cocoa. It's that time of year where I allow myself to do that. I don't drink coffee because it gives you dementia, and if you don't believe me, do some research. You'll find that's the truth. So hazelnut cocoa is what I'm drinking, by the way. No alcohol. Dollar index here. Okay, so we're looking at the. I'm looking at a line segment that shouldn't be there. I don't know what that is. If my kids were younger, I would have tried to. Oh, I know what that was. That was a section highlighting the volume imbalance. No, I didn't move that. So TradingView, keep yourself out of my charts. You don't want me talking bad about you. So dollar index, we have an old high. Now, everything I'm going to say here, I want you to think about what you have taken notes from previous discussions. So this is where you kind of like hold my feet to the fire because there's so many times folks will come and they'll watch a video or they'll see a post by me or I'll comment on something and it seems like I pulled it out of left field. Like, where did he come off with that? And admittedly, yesterday I did try to post a real-time analysis of looking at what I was looking for in terms of the relative equal highs, and I'll talk a little bit about that when we get into the Nasdaq. But I posted something, or I thought I did. X kept it in limbo, and it didn't actually send. So of course, when I came out and said, "Here's what I've done," it didn't hit as good as I was expecting it to because it was just lingering in my phone. It did not get sent to X platform. So admittedly, yesterday it kind of did look a little wonky, but it is what it is. I mean, technology is what it is. I mean, I've talked on live stream for hours, not knowing that the live stream was killed, and find out later on that I wasted my time talking. I loved the things I said; they were great. I wish I had them on recording, but I missed it, and it just went out there in the ether, and it's lost. So by me talking about the things I'm referring to here, it's very, very important that you go back through. If you didn't do it the first time, go back and look at my other analysis videos where I hadn't put that many of them out this year, so it shouldn't be that hard for you to get through it for the rest of the year. The the annotations, the ideas, the suggestions on my part where I thought the dollar index would go, why it shouldn't behave a certain way, what it would mean for other markets like the averages like Nasdaq and whatnot, how that helps your analysis for forex trading. This is the very first market I look at every single time. So I've been away for about a month or so, technically, not being in here every single day, grinding like I normally do. But having these annotations on the chart, don't just simply use my chart and say, well, that's good enough for me. Okay, I want you to be inspired enough to go into your own charts, annotate them, log them. What does that mean? Collect the things like I'm showing you here. By having it in old charts where you put it in your study journal, when you look back and seeing that these very things were highlighted in your chart back then, and then how price reacted off of it later on, it's very impactful for your learning, and it's the work that I talk about. When people study with me, if they don't do that part, that's what I refer to as being lazy. And it's not meant to be derogatory and talk down to you. It's to inspire you to stop doing those types of things and be more involved interactively on your end. Because simply watching my videos is not going to make you a good smart money concept trader. It will not do it. You have to get in here and roll your sleeves up and annotate your charts. Keep reference points on your charts and then come back to them at a later time and study what they did. But record your observations, what you think might happen. But in your study journal, you want to be very cheerleader, like you want to cheerlead yourself, inspire yourself like you always saw it coming. And it's positive self talk. But your annotations need to be genuine. They have to be real. They can't be, you know, trying to include every possible thing. What you're trying to work towards is understanding order flow. And I'll talk a little bit about that also. You want to know where the next draw on liquidity is. So where's the higher time frame, monthly, weekly, daily? And I'm only going to look at the weekly and daily interchangeably when it's necessary or when I feel inspired to do so. But you want to at least be referring to a daily chart, especially if you're, a scalper. By having a daily perspective, it really aids in your intraday scalps, your intraday swing trading, your short-term trading, definitely. But because of gap risk, I have personally moved away from short-term trading simply because there's so many things out there right now that could cause a huge, disparity between where price is right now and where it can go immediately, and that's gap risk. But overnight gap risk is the difference between where we settled, say, for instance, in indices at 5 p.m. Eastern time, and then where we open up at 6 o'clock. Imagine, we're trading normally, and I mean that, with quotations in the air right now, whatever that means for you. And then something happens after 5 p.m. Eastern time. Somebody drops a BOMB, somewhere in the world and causes a lot of chaos that way. What do you think the market opening would look like at 6 o'clock? It wouldn't be relatively unchanged from where it was at 5 p.m. Eastern time, right? At least, hopefully, you would know that. And that's the kind of climate we're in right now. And it may sound like Chicken Little, sky's falling, but you know, I'll leave it up to you to look at the things I said in the past, whether or not there's any relevance to it. But I just personally, that's what I'm trying to promote to all of you. I'm not trying to push you to, you know, place your foot on the gas pedal and go full bore, full port, everything, go, you know, hog wild, basically, looking for every possible, payout you could possibly get. You want to be very careful in these market conditions because the volatility is crazy, the uncertainty is very high, and there's a huge, enormous amount of manipulation. So it's important that you are aware of that going into this discussion, okay? All right, so if you were with me over the last few months, you know that I talked about how we were going to move higher off of this inversion fair value gap that formed after I said it was going to form. And I'm challenging you to go back and look at the time when we were looking at the market down here. I called this as an inversion fair value gap before it even formed. Okay, so that's why market profile is inferior, supply and demand inferior, Elliott wave inferior, Gann inferior, Wyckoff inferior, because you have to see something in the chart and then react to it. And I'm not reacting to anything. I'm teaching you to anticipate these things. I'm giving you rule-based ideas that are time-based and scheduled delivered. It's a scheduled delivery. Okay, just like we're entering the holiday season. There used to be timed or scheduled holiday programming like Charlie Brown. That's like my favorite. Charlie Brown's Christmas, Charlie Brown's Halloween, Charlie Brown's Thanksgiving, TV special. Well, just like every child, in the 70s, 80s, and 90s and 2000s until 2000, I think 20, I think it was, Apple took over, you know, the rights to be able to publish that stuff. And you can only watch it there unless you have the actual media. And you're probably saying, what does this got to do with anything? The fact that time scheduled holiday programming really was started with Schultz's Peanut special, Charlie Brown and Snoopy Gang. And everybody knew if you didn't sit in front of your TV at that time, you missed it. And you had to wait a whole entire year. Well, markets have this time based delivery mechanism too. And if you're not there when it happens, you miss that trade. So as a young 20-year-old, I got plagued by missing moves, and it became a fear of missing out on everything because I thought that, and you probably feel this way too, if you're new or inexperienced with it, you feel like if you don't get the very next trade, that's it. You're never going to make it, and there's this insatiable desire to feel like you have to be a part of the next move. Or if you aren't, somehow subconsciously you view that as you're not a trader, you might as well give up, and therefore you're wasting your time and nobody makes money. Everybody's a scammer, nothing works in the marketplace, and you just become bitter about it. And I've seen lots of people while I was coming up had that same mindset. And a few times I actually started to believe that myself as a 20-year-old because I didn't have success right away. It was a lot of floundering and failure and just not finding my way because I was listening to people that didn't really know what they're talking about. They sold lots of books. They sold really expensive courses for me at that time, but I didn't take ownership of it. I didn't have the ability to be responsible with my own actions or inactions. And I wanted to look for other things and other people to put the blame on my inability to define success with what it is I was trying to use back then as trading. But if you don't subscribe to some view of anticipating, not reacting, okay, I promise you this, the largest money that's made in speculation in the marketplace is made on the basis of anticipation, not reaction. Large hedge funds, they're not managed by people that are knee jerk reacting because they have to be in position before the moves take place. They don't have the luxury of you and I where we can get in with one contract, 10 contracts, 50 contracts. To them, that's nothing. That's literally nothing. They're moving billions of dollars in and out of the marketplace. And that can't be done on a tick chart. It can't be done on a 1 minute chart. It needs to be dispersed over a period of time in large chunks and blocks of orders that they introduce to the marketplace. Hey, sorry about that. This is the things that I always edit out. You're going to hear everything this morning, okay? So the idea is you want to learn to be anticipatory in nature as a trader. That means if you don't know what it is that you're looking for, you're never going to be able to anticipate and beat those that are trying to react. And what is reaction versus anticipatory? Anticipatory is knowing, for instance, like I gave back here, when we were trading at this candle and this one started, I told you that this was going to be an inversion fair value gap before we even traded up into it and through it. So that's understanding what it is I'm looking for. And I put it out there in the public view so that way, if I was wrong, all of you out there like hyenas looking for something to go on and chew on, I throw you a bone all the time. If I was wrong, you can come and say, see, he did that wrong. He did that wrong. And it's okay if I do it wrong. It's far and few between when it happens, but when it does, it's an encouragement to you because I am human. I'm not AI. I'm not artificial intelligence. And I can mess it up too, just like anybody else can. Sometimes, it's going to happen. But if you don't have a measure of anticipation, anticipate, I coined that. Don't anybody out there put that in their books, okay? That's my word. I just created it right here. November 14th, 2025. That's mine. Unless you have some anticipatory skill set that you've grown and then adopted by keeping journal entries and screenshots. Take lots of screenshots. They're free. They're absolutely free. It doesn't cost you any subscription or nothing. Dress them all up, put all kinds of lipstick on your chart, and all these empty spaces over here and over here and up here and over here. That's where you write down your annotations, your inner musings, the things that you think are pertinent to you right then and there, where it's safe to do it, where nobody can judge it, nobody can call you silly or you're a clown, you put this in your chart and it didn't do that. Don't be worried about those things. This is where you want to make those mistakes. You want to be able to see these things in a very disarmed environment. That means if you don't do something perfectly, there's nobody there to judge you over it. And the worst thing you can do is be the judge of yourself when you're trying to find yourself as a trader and find your model. It's really important you do that because I hurt myself psychologically, physically, emotionally by doing those things to myself. I talked bad about myself when I was trying to learn this because I expected it to be easy and fast. And that's why I'm such a hardliner about telling you to be patient with yourself, expect it to be longer than it would be otherwise. Someone else out there is going to sell you a course. They're going to sell you a shortened version of what it is I have taught. And they're going to promise you, I watched every video ICT ever put out, and I'm going to make it real easy. You're not making it easy for everyone. I promise you, you're not. Because everybody has their own baggage. And until you sort that out, and how do you sort that out? By journaling and writing down the things that you're thinking and recording what's going on in your personal life at the same time. Are you arguing? Are you fighting? Are you between jobs? Did you get fired? Are you potentially going to lose your job? Are you sick? Are you fighting an illness? Just recently I had to go through that same thing. I wasn't feeling well, and I had to take a huge step away from everybody to get myself well, and I feel wonderful now. But you have to take ownership of it, and you'll see that you are the problem. You are the problem, and you are the reason why you succeeded. It's not Michael, it's not ICT, it's not my concepts that made you successful. It's that you went through the process of pruning all the dead branches off of you that's stealing your vitality, your energy, your focus, your health, your attention. All those things need to be pruned, and the only way you do that is discover what they are. Don't let anybody else out there on the internet tell you what your problems are. And I'm not going to be the person to be able to do that either, because you're not going to be honest with me. You could be having an infidelity, uh, you know, escapade right now with your spouse. You could be living a double life. You could be, you know, a kleptomaniac going to the store and stuffing everything in your pockets and walking out of there. I don't know that about you, and you're not going to bring that to the forefront of the conversation if we met. So that's what I'm talking about. You have to be 100% honest with yourself about what it is that makes you tick, what makes you think, and you have to include those things at the time when you're doing your journaling. And that's why your journal should never be public record. It should never be offered as, here, look at my study notes. No, never do that. Never do that. Because by your willingness to do that, you're going to keep barriers and boundaries up. And those walls are going to prevent you from being honest with yourself, because you're going to feel like you're obligated to look better than you really are at your present state of development. And it's important that you remember that what you're doing right now is to make that inner trader inside you that's successful consistently and, well, consistently profitable, yes, but not in a rush to get to that state. It's hard to fight that urge. I wanted it to be fast, and it took for me too. But the easiest way to get there with the shortest timeline is to do everything I'm telling you to do right now and resist the urge to do it quicker. There's nobody out there that's going to make it easier for you or faster. I promise you that. It will not happen. You all have to go through this. And anybody that says that you shouldn't do it this way, this is a waste of time, they're the same people that are blowing their accounts on live stream, period. Simple as that. Okay, so there it is. That's the monologue. So now we can get into the charts. So I talked about how the dollar index would obviously use the inversion fair value gap here. And we had some bullish buy side unbalance, sell side inefficiency. And then we had another inversion fair value gap here with a suspension block. You can see the imbalances here. It's not noted like this one is here. I'm not going to draw that, but you can see it there and there. And then we traded down to consequent correction of that suspension block perfectly. Ran from that. I'm away from everything right now at the time. I'm back and forth, traveling on the roads with my wife, so that's why I wasn't able to do a whole lot of much anything video wise or whatever. And then we had this suspension block here, which is a bullish fair value gap with a volume imbalance at the high and the low of it. Okay, and then look at the bodies respecting the upper half. Yes, we can travel down to the low of it, which it does there, and then we hit the lower quadrant on that candle. Now think about this, folks. Tell me, where in volume profile is that? It's not. How about Wyckoff? Nope, it's not there either. Supply and demand? Nope. Elliott wave? Nope. Put a pitchfork there. Do it beforehand. Okay, do it beforehand. Don't go back and try to pick the highs and lows to make your pitchfork look like it worked perfectly there. And that's not how that works. Okay, believe me, I did pitchfork garbage. Okay, as a 20-year-old, I swore up and down I was going to pick the right trend line highs and lows. It's a facade. It's a facade. When you stop arguing against me as the man, take me out of the equation. I'm not important. I'm not special. Okay. I'm just simply the conduit. I'm the pen that he's using. That's all. So remove me from the equation here. Look at what I'm sharing. Look at what I'm telling you to focus on. If it didn't hold up, if it was contrived, if it's cherry picked, if it doesn't work, it wouldn't be perfect like this. It wouldn't be perfect. They form when they're supposed to form. They deliver exactly how I told you the loss would be shown in price action. There's no ambiguity. There's no, well, if it does this, then that's, no, 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 no. There's rules. What does that mean, Michael? What do you mean by that? This is my first time listening to you. What does he mean? I wish he would talk about what does he mean by that? If you're looking for something that's going to be bullish, okay? If you're looking at something that's going to cause and be a catalyst for price to go higher using my concepts, what would that look like? Well, I chose to work with fair value gaps for a lengthy amount of time in the last year and a half, not because that PD array is the best. It's not the best. I'm not going to give you my best. I'm not going to do that. Nobody would do that. Nobody would do that because everybody would prostitute it and pretend it was somebody else's thing and still have no proof to that either. Okay. The point is this: knowing what makes the market go up, there has to be some underlying premise. What was the premise on the dollar index? This low swept it there. And then we want to look for a low risk entry to a market maker buy model. Oh. So what you're saying is anytime that the market enters into a buy program, that means it's going to remain bullish for a length of time until it trades and traverses to an opposing pool of liquidity. That's the technical term that you'll see in the book. Okay. What this is it's smart money reversal. Smart money reversal will always, this is for your notes now, okay, will always be a purge on liquidity, whether it be a market maker sell model, which would be the opposite of this high down to that low, coming all the way back up, traversing right back to that liquidity there. Now, you may not recognize this as a new student or even someone that's been with me for a little while. You may not see this as a market maker buy model, but that's exactly what it is. They don't have to look perfect textbook, but the mechanisms behind where price is going and why it's going to go there is still remaining constant, meaning that yes, there was a willingness for traders to go long here. Wonderful. Supply and demand, not a factor. Support and resistance, not a factor. Liquidity, absolutely the lifeblood of the marketplace. So you got to stop thinking about, where prices caused the last buying thrust or the spring lower. Okay. Forget all that Wyckoff stuff. Okay. Forget all of it. It's archaic. It's simplified, simple stuff. It's so easy. All you gotta do is read it one time and you know everything about it. But now graduate from that. Graduate from it. Look at the market a little bit deeper because there's a whole lot more going on that are very, very precise, very specific things that repeat on a time-based delivery. When market went down below that low here, what was below that low? What would be resting below that low right here? In terms of liquidity, it would be sell stops, pending orders for two things. First, those individuals that went long or anywhere in here, they're not going to feel safe by putting a stop loss that's real short. They're going to want to go back to this low here because they're going to see that that is what? Well, that was very strong support because look how the market reacted. Yes, I'll give you that. It reacted like that. Wonderful. But I'm not looking at that as I'm gonna wait till it goes down here and touches this and go long. No, I want to see it go below it because what that will do, it will give me immediate feedback on whether or not this was a raid or if it's going to continue going lower. So it gives you a case study. It gives you an opportunity, like a laboratory experiment for the people that went through biology class or university. Remember that? You had to go through these labs. Well, this is a lab experiment every single time you're watching an old high and old low on any time frame. Why do I teach in the lower time frames? Because there's a lot of opportunity for you to do the things I teach and study. And you'll find all the evidence that this stuff works perfectly in your own hands. You don't need me making videos and recording things. So the market probes below that here. Let me move this up a little bit. So it moves below that low there. So it opened. Look how this candle formed. And these are daily candlesticks behind you up here, upper left-hand corner. And just for a second, if you would please, can you just give me a tweet let me know that you can see. I don't know why I just feel like I gotta just double check you guys can hear me okay. I apologize if I'm breaking up the continuity, but I don't want to be talking and you not be hearing me. Oh, I'm not getting anybody. Okay, I got two of you. Thank you, thank you, thank you. Okay. So when the market's reaching below an old low like that, I want to see it travel below it. And by opening above that low being here, this candlestick opened right there, right there. So the opening on that candlestick's price is 96.617. And then at that moment, it starts dropping down to that low. Now, support and resistance folks would be like, okay, it's going to go up right there and want to go long there. And they may elect to go long like that, but I'm not doing that. That's why I don't trade support and resistance. What I'm looking for is, does it trade down below it? Why is that important to me? Because number one, everything that causes the market to rally high and low is always on the basis of a market maker sell or market maker buy model. Every fluctuation in price action could be broken down fractally to that very premise right there. Now, it need not be understood at the beginning of your learning exactly what that means. It just means that you're going to grow in your understanding about what that means if you're studying with me. Regardless of what you trade as a model, your entry, your silver bullet, your model 2022, for instance, model 2022, that is low risk entry. That's the part of the market maker sell model or buy model that you're trading. You may not have ever identified it as such, but that's exactly what that is. Turtle soup, that's the smart money reversal. Maybe you've never known that. Maybe you never identified it as such, but that's what it is. Second stage reaccumulation or second stage redistribution, which is the unicorn of the models, that is the biggest, most explosive, sustained price run that trades to the opposing liquidity of a market maker sell or market maker buy model. Now, for someone that's new, that sounds like a whole lot of mumbo jumbo, but I'll explain it in a moment, okay? But those continuations are simply silver bullet premises applied to that time frame that you're seeing the market maker model on. Now, take a moment and think about what I just gave you. I compartmentalized exactly how I taught you to do it. If you went through my private mentorship in 2016, 2017, 2018, 2019, 2020, and the final one, 2021, those same lecture notes. And for the folks that keep asking for the PDF notes are simply watching the video. And every time a new slide or the way the presentation in those videos changes, take a screenshot of that and save all them in a PowerPoint and then turn it into a PDF. And you have the equivalent of what I was giving out. There was no notes in terms of like text or like amplifications. What I was telling the students were that were in the paid mentorship, what I was telling them to do is use the slides because I left ample space like this chart shows here. There's lots of room for them to make annotations. So I told them to take them and print them out. And yes, it was costly on their part for ink, but it is what it is. The uh, the idea was for them to write their own notes down, but using the slides. So there is no PDF. So please, I get hundreds of emails every single week. Can you please give me the PDF notes from the 2016, 2017? Make them yourself. They're simply the slides from the video. Screenshot every time the video changes to a new different presentation on the display of your video when you're watching it. That's all those PDFs were. There was nothing additional added to it. I swear to you in Jesus' name that there was nothing. If you are a charter member and you went through my paid mentorship, post it to me in X that he's telling you the truth, that there was no extra anything. But there's people out there trying to sell mentorships and they're lying and saying that this is the thing I'm hiding from you. I'm not hiding anything from you. Okay. It's up on the YouTube channel. You don't have to pay for it. So By having an understanding that the market's going to traverse from buy side to sell side to buy side, and it's going to move from buy program to sell program, buy program to sell program. Okay. By expecting the market to provide you stepping stones, little footholds, if you will, moving from one position to the next, it will free you up of this fear of missing out, which was a huge help to me personally because I had no real I had no real model when I first started. I was just winging it, just going, by impulse. Like, I feel like it's going to keep going up because it's gone up, so then I'm going to chase it, not knowing where it's going to go to or where it could stop going up. It's simply like, I don't know. Much of what I say all the time to all of you is you feel like you have to learn it real fast or it's going to go away. You're going to miss the opportunity. And if I was honest with you, I probably wasted more time worrying about that when I was young because it seemed too good to be true. The couple times that I made money when I first started, the few times that I made money, it felt too good to be true. And I was afraid it was going to stop working and I would never be able to do it again unless I made all my money really, really fast. And now, fast forward 33 years. Looking back, that was such a silly mindset, but it's understandable. It's understandable because if you don't come from money, if you don't come from an affluent lifestyle, you feel like you're fighting tooth and nail to get to it. And you have to do it fast because you want to get out of the pain you're in. And that is exasperated and magnified when you're trying to learn to be a trader because it's painful doing it wrong. It's painful not knowing for sure what it is you're doing. It's painful losing money, even if it's $25, $10, $1, getting stopped out and getting the commission still covered, but not making any money. That's painful in the beginning. And I wish there was a way for me to take that from all of you and prevent that from ever happening, but I can't. I couldn't do it in my own hands. So therefore, I can't do it for anyone else. You have to find your way in this stuff. But there is a path, there is a way that'll lead you to it, but it's going to require a lot of work. It's going to take a lot of study. It's going to be a lot of filtering on your part. And eventually, when you get to know what it is that you're doing, you're going to filter even me, which is exactly what you should be trying to do. Learn a model, learn it well, so that way you never tap back into me because you've graduated, you've moved on, you've found your way. Show me appreciation however you want. You don't have to. There's no obligation there, but simply cut off all outside interference because social media will make you feel like you got something that's less superior. What you're doing is inferior. I promise you, there ain't nobody out there that has anything better than this. I stand out here all the time begging for it. Prove that you have something more precise. Prove it. Call it beforehand. Outline it. I'm sharing all this stuff for free. There's no course. There's no mentorship. There's no paid mentorship for me. I don't do signals. I don't do investment things. I don't have a Telegram channel where I'm telling you to, I'm going to give you signals. I don't do investments. I don't mess with crypto. I don't do any of that stuff. I don't take payments for nothing. And you see these people out here ripping people off all the time. I'm never going to DM you. I'm never going to do that. So if anybody's doing that and they're pretending to be me, you're talking to a scammer. That ain't me. So by having the expectation and anticipating that price will drop down, let's break it down into even a smaller scale. And what I'm saying here is not just applicable to the dollar index, but I'm telling you what you can do with this information. You can scale this to any measure that you want it. You want to be a higher time frame chart trader? You don't have time. You can't be in front of the charts because you have a job. You're in university. Your lifestyle where you live geographically, you can't be awake at that time. Okay, these are real world problems. Now, I don't have an answer for everything, and some of you may be required to make significant changes in your personal life. And that, unfortunately, is going to be a decision factor for you. And I'm going to leave it to you to determine that. But for someone that wants to take a stab at this and learn how to do it from a less of an intraday perspective, you can do something like this. We know at this day when it opened up on this price, and we know we're real close to that low. So you can do something what I taught is called purge and revert. Okay, for students been around for a little while, you know what that is. A couple years ago, I revealed and taught it, and I don't recall if I actually have the video titled that way. So if you know where I talked about that, and a lot of my private mentorship students did way better job at itemizing and indexing what lectures had what at what minute marker. I mean, they were phenomenal with it. I just simply like a machine. I just like a fire hose. I'm just shooting out all the information, and then it's up to you guys to keep track of it. I know it in my head. It's not important for me to have it itemized and indexed. For you as a student, it's important for you to do that. And for those that are just now beginning to start studying my stuff, go through all the videos. There's no one better playlist than the rest. Okay, but if I could be honest and tell you, if it were me, I would start with whatever I've been doing recently and work backwards. You can't go wrong doing that. Okay. If you're really trying to learn, you're going to consume everything. You're going to watch everything at least one time, and the things that are really detailed, you're going to want to watch them a few times. And it's not for ad revenue purposes. You're going to see you'll go back to a video, and you'll watch it, and you'll swear up and down that I edited it, and I can't because they're still dated on YouTube. You can't edit the video once it's uploaded. You got to re-upload a new one. But you'll swear up and down that content was changed, and now there's something more useful to you that amplifies something that you swore wasn't there the first time you watched it. And that's the benefit of having 3 years, I'm sorry, 33 years of experience, and you going through a video one time with limited understanding. It's so much information, and it's dense, and it's boring too. I'm going to be honest with you. It's very boring. But you know what makes it really exciting? The first time it works in your hands. Even if it's paper trading, even if it's a funded account that you didn't get a funded account payout on, the first time it happens in your own hands, that's it. You've been infected, and you'll be very passionate about doing it. But getting to that point is going to be hard because it's hard to stay motivated, and it's very easy to be discouraged. That guy ICT never won Robin's Cup. That guy did this and that guy did that. I challenge all of you to have the perception of what you want to do with this information. I'm the least important factor. I'm the least important factor. And if I wanted to be a hero, I would do all the things that you want me to do, and it would make you no more money. It wouldn't speed up your progress. It wouldn't do anything for you, but make you a cult member. And that's what everybody thinks this is, but it's not. I'm not a cult leader. I'm just a simple man trying to share something that I wasn't really fit to receive, but I'm doing my part with it. You don't have a way to get in and trade intraday. Okay. This candlestick opens right there on that day. So right away, you know that there's a strong potential that the market's going to traverse from that opening price to that low. Okay. Why? Because there's liquidity and it's so close. It's called close proximity. This opening price to that candlestick's low, close proximity. So if you are a day trader, a scalper, what do you think might be beneficial for you in this condition right here? You know it's going to act like a magnet and draw you down to that liquidity because there's orders below that low. What kind of orders? Sell side liquidity. So that sell side liquidity is doing two things. Number one, it's protecting, quote unquote, the long holders with their stop loss below that low. Who would do that? There's lots of traders that do that. There's lots of traders that do that. But maybe there are individuals see that low and they think the dollar index is going to go lower. They see all the things that's going on in the Trump administration. They see all the things, the bad decisions being made on both sides. And maybe they're bearish on dollar. And they think once it goes below that low, they want to sell short on a breakout. Breakout artists selling short on a stop. So there's sell stops protecting long holders or sell stop entry as a mode of entering going short. So you can be a buyer or seller on a stop. That means it has to trade to your price. Just like if you're long and you had a sell stop below the marketplace at, say, for instance, 50 cents, whatever that would be, whatever the instrument would be, say 50 cents is your sell stop. As soon as it trades to at 50 cents, it's going to activate that order to do what? Be a market order to sell at market. Then there's limit orders where you can buy or sell on a limit. That means it has to trade to your price or better. So in other words, what would that look like? If you were short already, or if you're going short at the open, reaching down to that low, this low price comes in at 96.377. So if you put a limit order to sell, I'm sorry, to buy it back, you would be putting an order at 96.376 theoretically. Me personally, I would put it right at that low because I want to make sure that even if it just touches one tick below it, chances are I'm probably going to get that fill. And you can see it doesn't spend too much time down here. So as a day trader, in your Forex trader, when you see the daily chart, which is again what I teach many times, you want to look for these pools of liquidity, these draws on liquidity on the daily chart in the direction that the monthly and weekly instigate. Where is it really moving? Where's the strongest tide pulling us on that monthly and weekly chart? And there isn't a whole lot of changing of that tide. It stays in place for a while, but it's hard for you to stay on that side intraday because you're seeing 50 handle runs out of nowhere. Where'd that come from? Oh, I'm probably on the wrong side. Let me change my long-term bias to this now. What does it matter on a 1-minute chart, 15-second chart, 5-minute chart, 15-minute chart? What does it matter if it rallies up real strong like that when your higher time frame bias is bullish or bearish? That's infancy. That's immaturity as a trader because you're allowing short-term fluctuations and volatility to screw up your perspective and you get misaligned and you abandon this idea that's based on higher time frame premise and you get yourself in all kinds of potluck trouble. As a Forex trader, the day that it opened up right here on the dollar index, you know that what's the dollar going to do? Strong likelihood that it's going to traverse intraday during this daily candle. It's going to trade down to that low. And the way I teach, it's going to reach below that low because there's liquidity below it. Now, as a scalper, as an intraday trader, for Forex, if dollar's going down, if it's going down to that low, that means you have short-term scalps that you can go long on euro and pound dollar, Aussie dollar. Anything with the dollar index second in the name of the pair. That's a buy scalp because dollar's going to drop to that low. So right there, all of a sudden, now you have a real quick way of being able to go back and study things on your own charts. This same premise, even though we're looking at it on a daily chart, upper left hand corner, the daily chart time frame. If you see this low here, say it was a hourly chart that we're looking at, not a daily chart. Okay, same premise here. The hourly chart, if it opened, say this is an hourly chart, not a daily chart. Okay, and we're real close to that low. The hourly candlestick would be opening here. You know that it's likely to do what? Strong likelihood that it's going to want to drop down to that low. It matters not what time frame you're trading on. It's the same idea, same thing being applied. So if you're a scalper, if you're an intraday trader, if you're a swing trader, if you're a position trader, I'm an off intraday chart trader. I can't do the things that ICT is doing on a 1-minute chart. I need a mechanism to do this without looking at intraday charts. I'm going to come back to that. Just relax. But you can see how these ideas can be beneficial to you. And that's why I teach that if you use an hourly candlestick, like a daily chart, you'll never run out of setups. It's every single hour there's something to do. Now, I want to make sure I remind you that that is not an invitation to overtrade. And some of you that are very short on discipline just took that and said, he just said, I'm going to trade every hour and make money. Where's my funded account? That's it. Give me a code. Trades by Matt. TBM code. TBM. I'm going to get in there. I'm going to use this information right now. I don't want you to feel like you got to trade every hour. Okay. But the very, very astute, apt student of smart money concepts will learn over time that they can take a trade every 60 minutes. In fact, every 15. Every 15 minute, I can find a scalp every 15 minutes. And I can sit there all day long, running it up, and running it up. And that's what I did with those Forex accounts. Those 7-figure accounts that said didn't happen because I supposedly used a white label broker. Wrong, Jack. Wrong, wrong, wrong. Nope. Nah, that's not what happened. It's using this same logic I'm teaching you here. See, this is a master class. Okay. I had a couple companies come to me over the last few months and they propositioned me, listen, we would love to go into a business partnership with you and do a teaching circuit and go around the United States, Canada, Europe, and you know, it'd be a profit sharing. Obviously, I would get a 60% shareholder profit of the thing, but I would be basically going around talking and teaching and doing things like that. So if you were doing that, okay, and this is the kind of like snub my nose at those companies that are asking me to do that, why would I do it with you? No disrespect to all of you, but why would I do that when I could just do it myself and make all the money? Like, who believes that kind of stuff? Like, I'm a businessman. Stupid. So, but if I were doing that, this is how I would teach you. I would start off with something just like this, and it will allow you to formulate an immediate road and pathway for you to decide, what does that mean for me? Do I want to be a scalper? Do I want to be an intraday trader? Do I want to be a swing trader, a short-term trader? Do I want to be a position trader? Where are you with that? And in the beginning, I wanted to be a swing trader because I had a job. I couldn't do those things being in front of the charts. And by me studying intraday charts, I started thinking, I'm missing moves because I'm not trading intraday. And I got tripped up in thinking that that was the only way you can make money, and it's not. Now, for the working class hero, this is for you, okay? You can't trade intraday charts. You can't trade the smaller time frames because you just simply can't do it. That is not a problem. Okay, it's not. All you have to do is change your perspective a little bit. Okay, using the same thing I just did here. Now we're going to apply a different mode of thinking with the same underlying market conditions. Now, think about what we've done here. Close proximity to liquidity on a daily chart. That means intraday, the market's going to trade down to that low. If you're using intermarket relationships and it's the dollar index that you're doing the analysis on, it's likely to do something like this. That means that the Forex pairs that have the dollar index in the second name, for instance, the dollar's going to go down. Should be charging me money for this, man. I could be paying my bills. I could be getting out of debt. What is debt? What does that even mean? What does that mean, debt? I don't know. I haven't been there for a while. So pound dollar, euro dollar, Aussie dollar. So that means the pairs that have the US dollar second in its name, when it's opening here on the dollar and it's going to drop down into that low and below it, okay? When it does that, these types of currencies in Forex are going to go up until the liquidity below that low here is taken. Then the easiest low-hanging fruit objective for you is to sell your euro long, pound dollar long, Aussie dollar long. Now, for currency pairs that have the dollar index in the front of the name, that's USD, JPY. I hate that pair. I hate the yen. Dollar Swissy. Okay. And they will do the same thing. They will mirror what the dollar index will do. So there'll be some kind of a low that they're reaching for too. But you want to make sure, here's this very important. Please don't miss this point, okay? When you're trading with positive correlated forex pairs with the dollar index and your analysis is being framed on the dollar index all the time in forex. Always, if you're not trading with the dollar-based idea, you are trading blind. I promise you, you are not finding the success that you could have if you're avoiding this part. This part here is important for currency trading because what your opinion is about the dollar index until it's completely gone, it's the daddy. Okay, so we're in close proximity of this low for dollar. It's going to likely draw down to that. Dollar yen, dollar Swissy, they're going to drop too. But the low here's the kicker. The low that may be also something that you're aiming for, relatively the same time that this is being formed. So in other words, on Tuesday, July 1st of 2025, there might be a low on the dollar yen or the dollar Swissy, comparably at that low, but it may not take that low. How could that possibly happen? If the dollar's gonna take its low, why wouldn't the dollar yen and the dollar Swissy take its low? SMT. Now, right there, that has cleared a whole lot of cobwebs for some of you out there, okay? Because you think everything should be 1, 2, 3, ABC. The rules never deviate. There's never any kind of, you know, departure from what you think in your infancy and learning initially versus what the realities in the marketplace is. So having the analysis anchored to the dollar, that means when this low is taken there, that is when you close your short on dollar yen, dollars Swissy, or any pair that starts with the dollar in the front of the name of the pair. Remember, these up here with the dollar index to the right, there's a second name in the title of the pair. They're going to be moving the opposite direction. Okay, so very very important. You have to keep in perspective what the dollar's doing because if this thing's going to move, it's going to affect the currency pairs that you're trading. And SMT, which is a divergence. And visually, let me do it this way. Um, that's essentially what we're expecting in dollar. That low, this low piercing that low. That's the old low. This is the low we anticipate forming below the previous one. That's this visually here. But we may see comparably, we may see a low in the dollar yen, and it's getting real close to it, but it may not go all the way below. It might go right just above it and then pull away. And then you have the dollar Swissy, it might agree and go that slightly lower low. But what do we have? We have a divergence in positively correlated currencies. Dollar index based with the dollar in the front of the name, with the dollar index itself that we're showing here in chart form. This is what we anticipate in dollar. This is the reality with yen. It says, no, I'm not going to go lower. And this here does go lower. If this happens, that could be indicative of a shift in internals that's going to support or cause a larger magnitude reversal mindset on the dollar index because big money, remember I was telling you earlier at the beginning of this live stream, is that they don't have the benefit of going into the marketplace on a very small short-term time frame. They have to move throughout blocks of price action that they have to implement over time. It can't be their full positions placed on right now because they're trying to hide what it is they're doing. And they also have to use the available liquidity that's available in the marketplace. There isn't always the amount of liquidity at that tick in the next 1 minute candlestick time frame. All the price action that took place in that 1 minute or 5 minute candle isn't enough for all of these banks globally to shove all their orders in on that one candlestick. Okay, so that's not what they're doing. They're not trading on one candlestick entry and that's it, and then we're done. But what they're doing is they're accumulating the sell stops below here, and then they're buying more at that opening price. And that's where you, working class hero, that's you, Mr. I can't be in front of the charts intraday. Hang on 1 second. My puppy's right next to me. She's snoring. That's distracting me. Hey, Scotty, listen. I understand you're relaxing and living the finer things in life, okay, but you have to relax and stop snoring like that. I'm live here. I can't edit all that stuff out. She understood everything I said. Trust me. I'm the one that feeds her. So the opening price here, when price goes down below that, if you're a working class hero, okay, let me get this stuff off here. If you're a working class hero type trader or in the process of becoming one, you don't need an intraday chart. How can I take this information and use it? Okay. You can have the same expectation and anticipate that they're going to drop from that opening price down there. When does the dollar index open? That's very simple. That's a time that never changes. It's simple. That time, whether you have a job or not, your phone has an alarm clock, right? It should. You probably use it to wake up. to get ready to go to work. You set it to see what time the dollar index or whatever that pair or whatever, I'm sorry, not pair, that market opening price is anchored to. If you're going to be using um, index futures, you're going to have to decide whether or not you're going to use settlement price or non settlement price. You have to determine those things. I tell you always refer to both. And back testing and studying, it'll tell you which one you want to use if you're going to use this approach to doing it, which is non intraday based. But now, what do I do with this information, Michael? How could I use this to paper trade and get better? Notice I snuck that in there real quick, okay? Because I'm not telling you to do this with real money. I'm not someone that is positioned and licensed and certified to be a trade advisor. I'm not a CTA. I'm not a financial provider of information. I don't have that. I guess authority to do that. So we're talking hypothetically. We're talking about reading price action and studying it and getting used to seeing what it's doing over time. But if you, where are we at here? If you anticipate that price opening on that candle, and you want to be a participant in it, you get the opening price. See when we're in close proximity, like as soon as they close here like that, okay, wonderful. Then wait for the new candle for the daily chart to open up, get the opening price. Then you know that it's likely to traverse and go down to that low, and you want to see it trade below it. As soon as it does that, as soon as it gives you this information, you already know that you can have a buy stop. Okay. You don't have to be in front of your charts. It's on autopilot, complete and utterly nothing to worry about. You can apply this to index futures. You can try to trade it with Forex pairs. You can do it with stocks. You can do it with commodities, bonds. I'm not going to say anything with crypto. Okay. I know you see me doing some things with crypto, and that's just simply because I've been inundated with people. Please, 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 please. Once in a while, I'll share my ideas. Okay. But Bitcoin's going to zero. So stop bothering me. Okay. Just leave me alone. So the idea is that once it does this, you're not in front of the charts when it's doing this. You don't need to be. As soon as it comes right back up and hits that opening price again, if your premise is correct, if you are right about the ideas that you think that it's going to go down here and take the liquidity and then start the run on a smart money reversal basis, are you getting long down here at the low on turtle soup? Nope. Do you need it? Nope. Because your idea is it's going to go up to, now here's the test for you guys that have been studying through my private mentorship. Where is the draw after smart money reversal? It's a trick question now. Pause the video if you don't want to know. If you're watching it in real time here, I don't have the luxury of doing that, but you're going to be forced into the answer right now. So what you do is you want to take your high down to the low that formed intraday, and it comes back to that opening price. As soon as it comes back to the opening price and trades one tick above it, you're immediately inside of a new buy program. So this is kind of like a little play on words with order block theory. It's the reverse. Yeah, how about that? Wonderful. You'll get more information in the book. Don't worry. Don't buy the book. Let it go out in the marketplace. Trust me. Trust me when I tell you that. Okay. It's not meant for me to make money on the books. It's just meant for me to put it in written format. This opening price on that candlestick, as soon as it hits that, you can be long. But inside of this, where we at here? Here we have the high, and this would be the original consolidation or where the draw would be on a perfect market maker buy model. Market's going to go up here. But in your infancy as a developing smart money concept trader, you don't hold to that idea all the time. You have to have a low hanging fruit objective. What would that be? 3/4 of the move, okay, or optimal trade entry. Because if you studied with me and you went through private mentorship, you know that a market maker buy model and a market maker sell model does not have to go all the way back to the original consolidation or opposing liquidity. That's just the best case scenario. Now, best case scenarios are just simply that, a scenario. They're not an absolute. They're not a panacea. They're not a be all end all. It's going to only happen this way, like you think it should as a new trader. New traders think that way. It has to work like this all the time, or I don't want nothing to do with it. Go do something else because that's not what the market's going to do. Okay. I promise you, in the first 3 years of your trading, you're going to find out that you are probably 90% wrong about what you think's going to happen. And any money you make in the first 3 years is just happenstance. You aren't really equipped to be consistently profitable. Even if you are profitable, the first 3 years you're floundering. You're going to discover so many things past that third year. So if you're in a hurry to get profitable in the first couple months or the first year, settle down. This is a lifestyle. It is not a lottery win mentality where you go and now you suddenly have to make money all the time. You're going to learn so much about yourself, and it's good that it's this way because you're going to be much more mature as a trader. What I mean by not having to go all the way back from this low being taken out for the purposes of liquidity, but we anticipate it being a smart money reversal to take us up higher. Now, let me remind you, go back and listen to what I said all during this time. I was marking out all the things in here and then eventually in here and eventually up there. I was giving you mile markers. I was not bearish dollar at all. At all. It never happened. My videos have never been edited and I haven't deleted anything. They're still up there. Okay. Low hanging fruit objective would be reaching up to 70.5, which is the sweet spot or optimal trade entry between the 68, 79% retracement levels. That was the flagship pattern that I started teaching. But its foundation finds its way in every facet of my trading. What do you mean by that? For a different discussion. But here, this is low hanging fruit. That means that this is all you would require getting up to from that low. You don't need it to go up to here, but it still can. Now, working class hero. As soon as it opens and it trades down below here, okay, what you can do is put a good till cancel buy order in the form of a buy stop. As soon as that low gets taken out, you put a good till canceled buy stop in your paper trading account. Okay. When it trades there, then you use that low as your stop or maybe a little bit below it because you just want to have no concern about it. Once it fills, your objective is to aim for that 70.5 level. That's your working class hero model. You're trading the same things that we're trading with intraday charts. You're using very specific criteria. You're not willy-nillying and worrying about what's fair value gap to buy. You're not worried about what order block to buy. It's a very static price entry. It's very, very generic and it works. And yes, Virginia, I've made lots with it. Okay. So this model can be used on any time frame. Don't think that this is the only way to use this because it's a working class hero and this is how you use it on a daily chart. You can do this on 1 minute charts. You can do it on a 15-second chart, a 5-second chart. Everything you see here. What argument can you make against this whole price action, all these fluctuations? What's the argument that can be made that it would or wouldn't work in any other time frame? It's just your ignorance that would be in the way. It just proves you haven't studied all the time frames that I talk about. And there isn't one perfect time frame. What's the time frame you're going to trade right now? There's no perfect time frame. Price is price. It's going to exist on every time frame. It may not be trading in the PD array that you're looking to trade in the time frame you're watching at that moment, but eventually it will. And then that's the actionable point of entry on that given time frame. But there's all kinds of entries going on all day long. And to see these people sit on live streams and stare at price action, shaking their head, moaning, "Honest, I don't see anything I like," or I don't have anything here today. Why? Why don't you? Because if you understand what I'm teaching is a universal model. You can go into any time frame and frame out something that is actionable. Every day is an opportunity for you to work with these candlesticks on lower time frames and develop a skill set that once you acquire it on the lower time frames, you can place that same model in everything. It's a cookie cutter. Okay. The market profitability that's available to everyone is the dough. No pun intended. You want to make dough, right? Well, this baker never runs out of yeast. I can take that cookie cutter that I just gave you here. I can press that into any time frame in any market and ravage it. I could have gingerbread cookies, chocolate chip cookies, snickerdoodles, Christmas cookies, Halloween cookies, whatever holiday. I can make my own holiday, ICT day. Okay. I can press this into any market and cut out profitability. That's the power that's in your hands. You may not have observed it or understood it to this point, but I'm trying right now, proverbially, reaching into this microphone, into your screen. I'm grabbing you by your lapels and pulling you real tight. My nose is touching yours. Listen, this is yours. It's yours. All you have to do is start believing it. You have to work with it, get accustomed to it. Every time frame is tradable. Every time frame. These yahoos, whether they come from Goldman Sachs or anywhere else, okay? PhD, piled higher and deeper after their name. Oh, but I won this time in this competition. Whatever, come out here and do it live. Call every single tick live. Call it. I don't care about pewter trophies. I got millions of dollars in the bank. Millions of dollars in the bank. That pewter statue ain't gonna do anything for me. I could write books and sell books and go out and start a mentorship and start making millions of dollars every single week without a Robbins Cup. I don't need all that stuff. These people that win these competitions, they still can't sell their stuff. I'm out here paper trading in front of you, and you're all watching my live streams. You're all watching my videos, taking notes. Why? Because my stuff resonates with you, whether you like me or not. I don't care. But you know what I'm showing is the truth. You know it's the truth because you can't keep up with it. You can't outperform it. You can't do better than it. And that's what you're wrestling with. You're not wrestling with me because there's no competition, zero competition. And there's zero comparison. There's nothing like this, folks. You can't find anything like this in past, present, or future. I'm in every time frame, past, present, and future, and I'm destroying it all. Making a mockery. I'm wiping my soles of my shoes off on everything that's ever existed, moonwalking on it all, begging you, please just go in there and see if it isn't like this. And then you can cancel out all the other noise. There's no upsell. You don't have to buy anything from me. You don't have to be tethered to me forever. Once you learn how to do it, leave the nest. Don't come back. You're never going to see these people do that to you. They're never going to encourage you that way because they want your money. They need your credit card payment. Buy my course, join my service. Buy my course, join my service. And here I am, this boring guy with a demo account, mopping the floor with everybody. And why do they keep coming back? Because you know it's there and you want it. You want it. Now I'm telling you, it's a free. It's right there for you. But you don't need to be a market maker, buy model, or sell model trader that demands. Okay, we're gonna have a huge paradigm shift right here. We don't demand that it goes coast to coast from down here where deep sell side is all the way back up to the buy side, which I told you it could potentially reach for, but I told you specifically we're going to aim inside this inefficiency. Go back and watch the videos from this day all the way through whenever I was doing the commentary, but it basically stopped before I went away on the first week of October. I think I probably did 2 videos, maybe 3 videos. I think. I don't know. It wasn't very many because I've been out running around rambling. But that's where I took your focus in here on this inefficiency. Go back and look at the recordings. Why did I focus there and didn't press hard about that one? Because I just taught you practicing what I preach. The easiest draw, low hanging fruit, if you're trading a market maker buy model, is 70.5 of the range. What is the range? What is the dealing range? How you framing your market model, market maker buy model or sell model? Here's the high, and that's the low it's going to trade down to. Why? It's going to go there. So from that low, once it trades there or through it, when it creates that low and comes back up to that candlestick that trades down to the low, that opening price is very, very crucial. Very crucial. It is a PDA rate. I'm not going to reveal its name, but that function frames the whole basis of returning back inside the range, and that range is this. High, down to low. That's the range. Now, when I was on Baby Pips, I did I don't recall if it was a live stream. Honestly, I want to believe it was live stream, but I don't think it was. But either way, I did a lecture called "Trading Inside the Range," and this is an amplification of that very lecture. And I don't need it to trade outside of the range high here to be profitable. I mean, what happens if you just traded to this high here for a minor buy side? Why is it minor buy side? Why'd you call it that, Michael? Because it's not even at 70.5 of the full range that's here from here down to there. That's a dealing range. The market has dealt in between here. So if it goes back up inside that range, you're doing the same thing. You're dealing inside that range. So you're trading inside that range. That means you need to know what you're looking for. Where is there an easy draw on liquidity? Okay. If you're using this model here, and you're very, very new and you're scared, you have a whole lot of anxiety, you can't stop looking at your phone while you're at work, don't get in trouble at work. I've people email me, tell me they lost their job because they were watching videos, my videos at work. Come on now. I told you don't do that. Don't get in trouble. You need your paycheck right now. Eventually you won't, but you need it right now. So don't lose your job over this, okay? But if you're doing it and you're using this model, 70.5 is way up here, right at that high, conveniently. Okay. So what would be easy objective, low hanging fruit objective for you if you're trying to grow in that and you don't want to wrestle through all the anxieties that's going to come? Well, what's the first swing high from that low? Go back. Bang, right there. So that would be your draw to initially. So if you're trying to work out the effects of holding on to trade ideas or learning how to hold to a trade, but you want to graduate to it, casually and without a lot of pressure on you, use this approach. Okay. And also, you can blend it with purge and revert. Thought I forgot about that, didn't you? Where it runs down, takes out the low, which is a smart money reversal premise. Okay. A premise is not a narrative. Premise is it's probably going to do this. It means what? Go up or down once it goes to that level. That's not bias. That's not narrative. Narrative is price is going to go down below that low because there's sell side. That's narrative. It's going to go down there. And then now you start using a bias. Once it does that, I'm bullish. You see the difference between all these things? They're not the same thing. And when I see these 20-year-olds talking using my buzzwords that supposedly were rebranded from somewhere else, why don't you use the old stuff? If all my stuff is rebranded and you're constantly telling your people, which are really surrogate students of my own, they're mine. They're my students, they're not you. You're just getting a commission because you're using my name. But I'm teaching your students, okay? Eventually, they're all coming to me because they find out that you're hiding my name and you're trying to say that you discovered this on your own in these third world countries. They're eventually finding me. They're finding me in Iran. They're finding me in Iraq. They're finding me in Pakistan. They're finding me in China. They're finding me in Indonesia. They're finding me, folks. You're not going to hide very long. But I'm worldwide now, and I'm still for free. And I'm here today doing it for free still. and they're learning what you can't teach them. These ideas, these premises, okay, are useful to a certain degree and then they stop. Then you have to rely on further understanding. So, bias, narrative, they're not the same. Premise, not the same. It's going to go up to go down. It's going to go down to go up. That's a premise. Narrative is once it does that, how is it going to go up? Where is it going to go to next? Well, we're going to walk that out now. Purge and revert is where a low is taken out. Man, are you learning anything? Am I going too fast? Because I feel like I'm giving a whole lot of stuff here. If you've been with me for at least a year, is this beneficial to you so far? Are you learning anything? Let me know on X right now. I'm going to go heat up my cocoa because I waited too long between drinks and now it's cold. And I'll give you a couple minutes to reply to me. I'm going to run over here real quick, pause this, or mute this microphone for a second. I'm going to heat my cocoa up. All right. Whew, this stuff is hot. This cocoa's hot too. So, thank you for those that are taking the time to let me know that you're getting something out of this. Wonderful, wonderful, wonderful. I don't know how many people are watching, and I don't ever really want to look at it because I get stage fright and clam up, and I run out of words to say and get confused. That doesn't really happen. I don't really know how many people are watching, but if you're here, it's awesome. I'm glad. And if you missed the beginning of the live stream, it will be on my YouTube channel, so don't worry about it. If you can't stay for the whole thing either, don't worry about it. It's going to be on my YouTube channel. So we can you just give me an audio check? I just turned the microphone back on off of mute. I don't want to start talking again and it not be. Just give me a 5 by 5 real quick, and that means all I'm looking for is just one. If I get one of them, I'll continue. These are the things that make it uncomfortable for me with a live stream because I usually once I get in a flow, I want to stay with it. And if I take a break or if I have to keep checking for things, I have to. Thank you so much. Thank you. Alrighty, so purge and revert. Purge and revert is when we take a low out like that. If you're reaching down below old low for liquidity purposes, now this is a very, very powerful concept, but it doesn't require a whole lot of movement. There's not a lot of moving parts either. Okay, so as soon as the low is taken, you go back 3 days. 1, 2, 3. That high right there. That's the liquidity it's going to draw to. Easy, 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 easy peasy lemon squeezy. That's it. That's your model. You don't even need it to go back to this high. You don't need it to go back to this high, that high, that high. 70.5 level of that range. And for those that don't know what I'm talking about, again, let me throw it right back up on the chart. And then sweet spot optimal trading tree, 70.5. So that look at that high, right sitting right there. It's almost like it knew it was going to create that, right? See, that's what I started seeing. These things, that low didn't even exist yet, but this so happens to be right at the 70.5 level. And you're going to tell me there's no algorithm that's going to know in advance how far it's going to run before it goes there? Come on. Come on, folks. Listen, how many times are you going to come home after work and your pillow smells like another man's cologne and you don't own that cologne? How many times are you going to see that and start suspecting maybe there's somebody else in my bed? Hello. This is what it's like. You start seeing these signs that there's something that ain't right. They're telling me in these books that price is reacting randomly. It's buying and selling pressure. But yet, why am I able to see these things back then? And when I was 20 years old, how am I able to see these things so perfectly aligned that goes against what they're talking about in these books? Come on. So these are like little signatures, little epiphanies that I would see, and this still quiet voice would say, "Look here, look here, look here." And then I would investigate it. I would dig into it and say, "Okay, what's so important about this?" And I'd say, "Okay, let me look back over the last few days and the last few weeks and the last few months." And I'd look at different markets, and it would be there too. I'm like, "Wow, none of my indicators are lining up for a buy there. None of my stuff, none of my stuff, all of the trend lines I was drawing, I had trend lines all over the place, all over the place." When I was 20, I was trying to build an idea of hidden trend lines, the ones that worked. And I wasted years with that crap. Diagonal support and resistance is not necessary. Okay. I know there's traders out there that have came forward and they swear up and down that's the reasons for they're making the money. That is not the reason why you made money. Okay. That's not the reason why you made money. The reason why you made money is because you took action on something and you managed that execution once you entered it. That's it. The catalyst that you're placing emphasis on is not the catalyst that caused the price to go up and down. I promise you that. I promise you that. Billions of dollars are not being made or lost or risked on diagonal support and resistance. It's not happening. It is not happening. But if you are subscribing to that view, okay, if you place a 40-day or 18-day exponential moving average on the time frame you're looking to trade, that will be the best trend line for you. Period. End of story. Done. So stop worrying about what high and low to anchor to. There it is. I would love Tori to try to apply that. Use it as a filter because I love the fact that she's came out there and says, "This is what I'm doing. This is all I'm doing." I'm talking about Tori trades, by the way, and it's not dogging her out or being derogative. I love her. I think she's a wonderful personality for the females in our industry because it's mainly a guy. It's like a locker room around here. Okay. And I get a lot of flack and people call it simping, which I had to look up and find out what that meant. I thought they were talking about like Bart Simpson, like Simpson, something like some kind of reference to him. I know I'm old, but I encourage people. Okay. I don't care, if you're a female or a male, but I like to inspire the females because the males are just sometimes just ugh, too arrogant, too bloviated, and they just think everything is about them and nobody else can do what we do as men. And that's not true. My best student is a female, and she still is my best student. And she's not on social media. She's not selling courses. She's not doing any of that stuff. She could care less. We laugh about it all the time. Like, you realize that they all want to know who you are, and they're like, please, I would never do that. But it's a female. My best student would mop the floor with anybody every single week. Profit, profit, profit. And she learned exactly what's in that 2016, 2017 paid mentorship lecture notes or lecture series that's on my YouTube channel. That's where she was at. She was in there. She was in there. And if we were having an interview, she would tell you that that was more information that she got directly from me sitting next to me side by side. And there you go. You don't need more. You don't need more. But you do need to know what it is you're looking for and how to apply it. So let's get back to our discussion. Persian revert could be your complete model if you're outside of intraday charts. Using a daily chart like this, are you going to get a lot of trades? No. You won't trade every day. But guess what? You have to be willing to accept the fact that you're demanding a whole lot from the market. Give me setups with only this criteria of time availability. Oh, this is what you get. You got to wait for, you know, key highs and lows. And I'll amplify that in a minute. But purge and revert is the high after a low's been taken, go back 3 days, whatever that high is, that's the liquidity it's going to run back to. It's high probability, short term, basically algorithmic trading. There's many algorithms that fire on that same premise that this is what I'm looking for. And I'm done. They're not aiming for 70.5. They're not aiming for the full run up in here. That's a best case scenario. So if you're trading turtle soup ideas with technically what it is smart money reversal. Okay. I love the cute little name that Larry Connors and Linda Rasch came up with for their Street Smarts book. Street Smarts book. I'm having an old man moment. Make sure I'm saying that the right. Street Smarts book. I think it is Street Smarts. Um, she's blocked me still on X, and I think she thought I was one of those. Like I get a lot of people posting pretending to be me. When I post on X, there's all these posers out there that have my name, my face, or they slightly change my name. To pretend that they're selling a mentorship or that I'm selling a mentorship and I'm not. I block them all the time too, and I think she ended up blocking me. I've never been critical of her. So Linda, if there's any way, if there's any way that you could, hear this, I would appreciate it if you unblock me. I'm not looking at everything you're doing all the time, but it feels kind of off that she blocked me, and I've been one of the biggest promoters of her book, and I think it's wonderful. She's a female. She's acclaimed in our industry. Um, I don't trade like her, obviously, but I have a same respect that I have for Larry Williams, and Tom DeMark. And even though Tom DeMark is not a good trader, I love his contributions to the community. I don't subscribe to his stuff like sequential and stuff, but I thought that there was something to it back then. But these are old people in the industry that I look up to. That they walked before me, and I would never try to tear down those individuals. And I know you think I'm tearing down Wyckoff and all this. The only thing I'm doing is reminding you that what I'm doing is not his work. It's not. And anybody that's highly critical and spends any time with what it is I'm teaching will tell you, yeah, it's not there. It's not Chris Laurie's stuff either. I gave initially a nod to Chris Laurie. And I want to be a name dropper today because this is my last live stream for the year, and there's no guarantee of tomorrow. But I promoted Chris Laurie a lot. I gave him a nod, and he's made millions of dollars off of me pushing him. Okay, not the other way around. I don't trade his stuff. I did not learn his stuff. I can show you the emails where he gave me a password and a username to go in and ask me point blank to give him criticism on how I could tell him to improve his teaching. And you can say whatever you want to say, but I can prove that. I have that. So yeah, I saw his stuff. Yeah, I saw that. I said he was the person on forexmentor.com, the only one that had a clue what they're talking about. But none of my stuff is Chris Laurie stuff. I had him come out on Twitter, and I told him, I said, I'm getting ready to do a class action lawsuit against somebody else that's bad mouthing me, and they're using my stuff. Now, I'm going to name you in this, and you're going to get drugged into this court case unless you come out and tell the public the truth. I'm going to come out and I'm going to make a post and I'm going to say, do you see your work in mine? What I'm teaching, is that your stuff? It's simple as that. You do this, I ain't got to worry about it. It's done. And he came out and said, no, and then added, but every trader needs to find their own blah, 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 blah. Okay, so he was still finding a way. And it was still efficient enough for me to say, okay, see, I told you all. He said no. No. The man himself said no. Okay. I thought it killed it. But I felt uncomfortable because he added this little bit of caveat towards the end of it. And I later found out with other people that are in his thing, they would email him about me, and then he would be double mouthed, talking out both sides of his mouth. Oh yeah, well, we all figured him out eventually, talking about me. And that to me is snake like. Okay, if you got a forked tongue, I was wrong in my character assessment of him. I was wrong. I was wrong. I have never badmouthed that guy, never, until I found that out. And then I came out and talked about it. I will never give another person a nod like that ever again because it was abused. And I've never said anything bad about the guy. And in emails, people are telling me, showing me, here's what he's saying about you. Well, dude, if you're going to be like that, come on. And that's why he's deleted that post. Go back and look through my ex. You can see where I say, thanks, Chris. The tweet I'm replying to is deleted by author. That was Chris Laurie. where he said, no, his work is not seen in mine, period. And if you're a student of Chris Laurie and you've been with him for a long time, you know I'm light years beyond that. Beyond that. And you don't see him come out here calling every tick and everything in the marketplace. You don't see that. You'll see him draw a line saying, here, we're going to look at, we're going to watch it from here to here. That's not buying and selling. That's not entering a trade. That's not trading a real account. They ain't using AMP. They ain't using TradeStation. Okay. That's not using a regulated broker. Okay. So there you go, kids. That's the facts for you. Stick that in your algorithm. So taking this one step further, because I do want to get through this before 9 o'clock. I'll stay with you until 9, but I do have to escape then. I promise it ain't going to go 4 hours. I promise you that it's not going to go. Mainly because I'm hungry. Purge and revert is a very short little run to liquidity, opposing liquidity. Okay, and you don't need a whole lot of the run inside of the dealing range to get to profitability for your setups. So the idea is this: when we're looking for prices to move higher, we are entering, or should have entered, a buy program. As soon as price gets back above this opening price, that's essentially what we're doing. So from that point here, now watch, this is what you want to internalize. From that here all the way up to that high right here. Now, why am I picking this high right there? Because that's the 70.5 measurement from that high down to that low that formed. So that's the low hanging fruit objective for market maker buy model. Before you get to that, you can use purge and revert, which is the high 3 days back from when the low was taken. And there it is right there. So you don't even need this. But inside of this range here, let me take the larger blue box off because there's a whole lot of things going on here. From this point here to that opening price, that is the core of your buy program. That means every facet, listen, every facet of my market, not Wyckoff, not that stuff, my market maker buy model and sell model, all of the pertinent details for entering it are going to exist inside that range. What do I mean by that? Watch. He's always cherry picking. My cherries are always the sweetest, baby. All right, so here we go. That's that range just being projected to the buy side of the curve. What does that mean? If you went through the mentorship, go through the 2016, 2017 mentorship playlist on my YouTube channel. Okay. That is my paid mentorship. That is the thing that people paid me for. And you are all still asking in email to join. Why? Why are you asking that? Why are you paying other people to learn what I've already given away? All you have to do is take a little bit of time, go into the playlist, go on my YouTube channel, click on playlist and look up 2016, 2017 private mentorship. Okay. Those playlists are the very lectures that I gave live. These things were done live in front of people. And if I was calling it wrong, they would all came out and burn me in front of everybody at the stake. And it never happened. For years, every day, every week, every month, every mentorship year, gangbusters, perfect. And everybody was parroting me. And they looked great on the internet until it stopped. And now they're like, do another mentorship. I need to be able to look smart again. No, no, I won't do that. So the buy side of a market maker model, okay, market maker model is the down to go up, okay? This is smart money reversal. Let me move it up a little bit. The low is the smart money reversal that takes out opposing liquidity. And now we enter right on this candlestick's opening price. We enter the actual buy program up to 70.5 of the previous days or previous trading dealing range, which is that high, which is the highest high it was prior to it dropping down to that low. That's all we're doing, okay? That's why I'm picking this high. It was very reactionary, impulsive. It dropped aggressively. There's a lot of momentum away from that high, and it's easy to frame it. That's an easy high, and that's the low we anticipated forming. And as soon as that candlestick trades back above the opening price of this candlestick, then we entered technically algorithmically, we're now in a buy program. That means the market is now bullish order flow. Stop worrying about these level 2 garbage trinkets of deceit. Stop worrying about that stuff because now everything's going to march to this Pied Piper's tune. I got a saxophone, baby. It's not a flute. I don't play the flute, okay? I got an alto sax that has that raspy, bluesy, so smooth to the ears. It tickles, doesn't it? And these candlesticks march to that. Don't believe me? Watch. Inversion fair value gap that was called before it formed. Volume profile. What? Yeah. Trades above it. That close right here, above the inversion fair value gap. There's a small little imbalance in here, volume imbalance. So yeah, incorporate that. That close right there, bang, validates it will be an inversion fair value gap. Now, for the inversion fair value gap crowd, I see a couple guys arguing. I created the inversion. You didn't create crap. Okay. You learned from me. That's what you did. So please stop doing that. You're just inspiring me to be the old me, and I don't want to be the old me. Okay. Don't make me come out here and wreck you boys. The point is it validated the inversion fair value gap. So we'll let it run a little bit. Let it have a little bit of rope. Let it run. Just like your pet is going to run until it gets to the end of the leash, and then it's going to come right back, bang, right back down to what? Consequent encroachment. That funny, weird name. I wish he would have gave it a different name. Trades right down to that midpoint of that inversion fair value gap. Perfectly. But there's no algorithm. Then it rips and roars to purge and revert. Rallies beautifully. In the process, it creates what? Buy side imbalance, sell side inefficiency, and a bullish fair value gap. 2 down closed candles inside of the inversion fair value gap and the displacement higher, that opening price right there. It's consecutive down closed candles. That opening price, draw that out in time. It's using that, but incorporates the entire buy side imbalance, sell side inefficiency. So if you were going to go long and you were looking on the basis of smart money reversal entry, it's always a turtle soup of a market maker buy or sell model. Always, 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 always. Romeo, Mr. Turtle Soup. Man, that guy. What in the world? Listen. I've seen some characters on the internet. Let me tell you something. I have seen some character. I have never seen the level of nonsense that comes out of one person, but that guy. You didn't create or invent anything. But here's what you need to know. Turtle Soup, cute little name. I adopted the name. I didn't create the premise. I didn't create the function, okay? My interpretation of smart money reversal, because I wasn't trying to teach every facet of my market maker and buy sell models. I was spoon feeding, dripping crumbs slowly. But I loved the kick in the gut that Street Smarts books title that they gave to attack the premise that the turtle traders, the millionaire club, okay, Richard Dennis that created off the street, different people, different walks of life. He went and found some people that I'm gonna create profitable traders off of people coming in and all different walks of life, not formally trained. And he called them the turtles. The turtles, kind of like the Ninja Turtles in Master Splinter. And Larry Connors in Linda Rash's book makes a little snub that they get caught doing their 20-day breakout buy or 20-day low short breakout. In other words, what I was describing a little while ago, that this low here, traders that would see that break below that, a turtle soup trade, I'm sorry, not a turtle soup here, a turtle trader by Richard Dennis, they would be going short when that low was taken out. And don't believe me, don't take my word for it. Go and look up the turtle system. It's simple. They buy a 20-day high on a breakout, or they short a 20-day low. That means the lowest low and the highest high in the last 20 days They're waiting for that to be breached. And they had less than 40% accuracy, in the 30% accuracy range. But their long-term trend following ideas, a lot of losing trades got paid off and offset by big long-term trends. That's what it was, that was capitalizing on that. So their name in the Street Smarts book is Turtle Soup. They got caught in soup, which is a false breakout. And I fell in love with that. I was enchanted with that sarcastic way of ribbing Richard Dennis's approach to teaching these people. This false breakout idea was more superior. It had a higher win rate than that of the turtles. But I promise you, the turtles collectively have made more money with that pattern than Linda did with her own trading and Larry did with their trading. And that's not a knock against them. It just, they've made hundreds of millions of dollars on that one breakout idea that Richard Dennis gave them. It doesn't mean that one is better than the other, because there's a time when you can use that system and do very, very well. What do you think would happen if you used the turtle's actual method of buying a 20-day high during a seasonal tendency that's bullish for the next 6 months? Do you think it's likely that's going to be beneficial for them to follow that model, or less likely to be panning out profitably? You have seasonal tendency behind you. So in a model and approach to trading using that type of mindset and seasonal tendency behind you, like the wind in the sails, it would be beneficial for you to have that mindset model applied at that given time. But what would happen if you're trying to use that model when the seasonal tendency is expecting to see crude oil prices to go lower, but you're buying a 20-day high breakout like a turtle trader would? What's likely to happen? A false breakout, and then the seasonal tendency pull it down lower. So, when I first learned what the turtles method was, because I learned it from Larry Williams, because he actually teaches it in. He bought it, paid $100,000 to learn it, and come to find out, it's a simple 20-day high and low breakout, and it's a trend following model, and there it is. And I was like, "There's no way it's all it is," but that's all it is. That's all it is. And he taught it in his Future Millionaires Confidential Trading course for VHS tape. You hear me talk about it all the time, and it's just simply what I just told you there. So that's the model. But Street Smart's book, their name for it was just right up my alley, because I'm very sarcastic. A lot of times my humor is not picked up on by most people, because sometimes it's dry and sometimes it's very direct. And times I've been very, you know, offensive with it, because it's part of the character, the Steve Austin, Stone Cold Steve Austin approach to drawing up a crowd. I have a big enough crowd, so I don't have to act like that anymore. So when we have the market enter into the actual buy program, and again, for definition purposes, because I know you're doing mentorships and you want to make some money, the idea is this: once you are in the part of the market maker buy model, you want to encapsulate where my stuff is going to form. Where is it going to form? Not when. I'll tell you when in a minute. Where is it going to form? It's inside of the previous daily range, high and low of a market maker buy model. And you have to find the 70.5 level of that range, which is what we already identified. And it happens to be just right at that high right there, which is the reason why I told you to focus there back in September, October timeframe. Go back and watch those videos. Go look at the posts. Go look at it, because that's what I was doing. I'm not cherry picking. I'm not form fitting anything. I'm telling you what I'm doing, why I'm doing it, how I'm doing it, so that way you can study it going forward and adopt it as part of who you are as a trader for free. So inside of this range, all I'm shading here is the same range from that opening price. Once we ran through that low and it came back to that opening price and went higher, that's validating that that was a stop hunt. If everything is true, now listen, this is the if then statement, or the syntax of the algorithm that you should be thinking like when you're looking at price action. When we're looking at things that derive the outcome that we're hoping for, being profitable, if we're going long, we need to know where we're going to enter, and how will the underlying order flow prove to you that it's bullish, without looking at level 2 stuff, without looking at horizontal volume, bars proving yesterday's news exactly what happened, because that's what it is. That's what you're doing when you're looking at these volume things. Okay, whether it's vertical at the bottom of a chart or they turned it horizontal because it looks cooler. It's cool. It's telling you the same information. Yesterday's news. It's old stuff. Are you going to be able to pick the right bathing suit tomorrow's beach trip based on yesterday's weather report? Who does that? Are you going to dress for rain because it rained yesterday or 2 days ago? And you're going to wear your rain jacket and galoshes tomorrow because of that? Nobody does that. Nobody does that, not in a sane mind. But that's exactly the equivalence of what they're doing. They're looking at old stuff and assuming that that has relevance to right now. It doesn't. Right now has relevance to right now. And you need to know what the weather is going to be tomorrow based on all the barometric pressure. Okay. So here we're inside of a range that has the high probability of sending price higher to the 70.5 level. And now we're going to be looking for footholds. We want to climb this rock surface up to this high. From this low right here at that opening price, we believe it's going to start gravitating towards that high because it's 70.5 of this entire range. That high down to the low that formed. So now you're a rock climber. You're bullish. You don't care how many orders are sitting below the marketplace. Oh, there's an iceberg order right here. Look at this. Look at this. ICT's going to get wrong. Watch this, guys. We're all in our little circle jerk right now, and we're going to prove this. We're going to well, that failed too. We'll get it next time, ICT. We're going to get you next time. The bottom line is you're going to look for all of my PD arrays to form, all of them. Whether you like one special one over another, it doesn't matter. You need to equip yourself, generally with month 4 content of my 2016 mentorship, the playlist. By having an overview of the PD arrays that I shared in the private mentorship, it gives you a well-rounded base, a foundation that if you just know those generally, you don't have to be entering all your trades on every single one of them, but be familiar with them. You will be able to ferret out everything that's in my chart right here. Everything that's right here is taught in my 2016 mentorship, 2017 playlist. It's there. And I used it real time with you when making these annotations and telling you where the market was going to go. And look where it went. And look where it's at right now after going there. The buy side here, perfect. Ran it. Now what's it doing? Those turtle soup buyers on a breakout are getting souped. What do you think this is? From here to there. It's the opposite of what we're outlining from here to there. It's a market maker sell model. Yeah. Everything's fractal. Everything is fractal. That means the thing that you're looking for in price, that's your fractal. Think of a fractal as your cookie cutter. That thing that you press into the dough that shapes every cookie the same way. But no matter how rigid and how perfect and expensive that cookie cutter is that you went and bought from Tiffany's, you press it into a dough ball that's flattened out on your countertop. Not every single one of those cookies that you cut out with that cookie cutter is going to come out like each one of them. There's going to be slight little deviations. Sometimes the dough will still grab because you didn't press down hard enough. That means you didn't buy enough. You didn't short enough. Sometimes you'll pull it out and you have to reball it up and smooth it out. Well, that's a stop out. You got to just do another one. You're not throwing the cookie cutter away because when you press it into the dough, it didn't come out uniform like the last 6 one or last 12 of them. A baker's dozen 13. Tell you, I don't know where this stuff comes from. It's got to be the Lord because I'm not this witty. But we have the buy side and balance, sell side and efficiency and order block here. It trades down into it here. Now the wick is allowed to do the damage. This is what I teach in my ideas of order flow. That is not inefficiencies. That's always existed in the price action. Okay, that's not single prints. Okay, Stadelmeyer, whatever. These people are. Go and look. Please go look at everything that everybody says that I'm copying. Go study all that stuff. Go study it because that way you will know what I'm teaching superior to that. It's superior to it. And you'll know without any doubts that you are learning from someone that's telling you the truth. I'm gaining nothing by doing this. I could be making millions of dollars teaching it. But I want some of you that send me emails, asking me my opinion about these things, go study what these people tell you, and you're going to see what they're saying is full of crap. There's no truth to what they're doing. They just expect you to have a TikTok mentality and believe, oh, there's been 50 people say this about ICT, so it must be true. It must be true. Okay. The bodies are allowed to stay in the upper half of a inefficiency that I call as a fair value gap. Nobody, Chris Laurie included, and the guy that he will never name that he learned from, ever taught it that way. Ever taught it that way. The wicks are allowed to do the damage. That means they can traverse down below the midpoint of that fair value gap. The fair value gap is this candlestick high, this candlestick's low. That's why it's shaded in that blue area right there. Dividing that in half, okay, and you get that little line to appear when you toggle that box. That's the halfway point. So if we're looking at an inefficiency or a wick, it's always called consequent encroachment. Consequent encroachment is the midpoint of an inefficiency or gap. If it is a candlestick like this one here, or these two, that's a bullish order block. The middle of that is called mean threshold. Same underlying premise. It's a midpoint of a distinguished range of price action. The two disparaging classifications is one's a inefficiency or gap, and then the other is a delivered range. It's one candlestick or consecutive candlesticks that comprise a order block. Order block theory is mean threshold for halfway points. Anything other than an order block, it's going to be an inefficiency or gap. That means consequent encroachment. That's just simply for language purposes, so that way I could teach my kids, and that's why the names are given to it. I knew what I was doing with it. I didn't need a name, but for me to be able to teach my kids, I had to have a language, and that's the language I force everybody to learn. So it's supporting bullish order flow because the bodies are allowed to go down to the low, below that midpoint of this gap, but it doesn't close below the midpoint. You see that? So every single time it does this, boom. Let me zoom in because I really, really want to drive this home. These are things that need to come off my chart first, but watch, folks. I mean, this is fun. There's no algorithm. Level 2, baby. Level 2. I'm on a totally different level. I'm way past level 2. I'm on my own level, okay? And I'm sorry, but there ain't no measurement for the level we're on. This wick drops down and gets real close to this candlestick's high. Now, when it's bullish, what did I teach you? The best case scenario, okay, in everybody's ideas of inefficiencies is it completely closes in the inefficiency. That means this candlestick's high right here, it would touch that, a la Chris Laurie. Okay. Does it touch it? No. Look real close. See that? It doesn't touch it. And so that's what I want. That's what I want, folks. And this level here is the consequent encouragement right there. We'll darken it up right there. See that? And by the way, I don't want you guys trolling Chris Laurie. I'm not saying this for all of you to act like wild wolves and hyenas and go over there and start messing with him. That's not what this is. But I'm so sick and tired of 2 or 3 people come to my email box every month or so and say, you stole Chris Laurie's concepts. Bull crap. Bull crap. I'm just being the upstanding man and not bringing out the receipts proving it. Ask him. Ask him if he gave me free access to his stuff. Ask me. Ask him if he'll be honest about that, because that's exactly what he did. And tell him to share the emails that he sent to me that I can produce. I can produce all that stuff. I'm just not that kind of person. I could be wrecking everybody. All these people have all that stuff about me on their websites and their YouTube channels making money off of it. I could wreck all of them, but I don't lose sleep over it. They need to do those things, and I'm still out here untouched. Consequent encroachment. It wicks down through it. Now, as soon as it creates that wick down here and it doesn't completely close in and comes right back up here, I already know at that point that order flow is absolutely still bullish. No level 2 required. No footprint. No volume profile. I'm not looking at volume nodes, point of control. The control is me. I'm controlling price. I'm controlling it. I'm controlling where this is going to go next. I know it's going to 70.5. I know it is. And yes, Yes, you 20-year-olds, that pisses you off because I sound arrogant. I sound like I know everything. I don't know everything. But at that moment right there, I absolutely know. I absolutely know that everybody else that isn't using what I'm teaching is clueless. You are blind, leading the blind. And that's the facts, Jack, because this didn't deliver all the way down to where it could have, and it didn't. And it closed up there. So now I'm expecting what? We got a new wick. We got a new wick. What do you do with that? ICT. What do you do with that? You measure it. What do you mean you measure it? What do you mean? That sounds silly. Who's measuring wicks? Was it Elliott Wave? Was it the pitchfork crowd? No! That's so silly. Supply and demand. Talk to me. Talk to me about Wyckoff. I'm gonna point something. It's sitting right there in front of you right now. Find it in Wyckoff. Find it. It's not there, but it's where I said it's going to be. Order flows bullish. We're inside of a buy program. It's going higher. Well, how can we trust it? How do we know? Okay. So if you look right here, very faint. Okay. Um, I'm measuring this wick. Okay. I'm going to take this little fair value gap box off for a second. Okay. So you can see it a little bit more prominently. And I've measured this closing price down to that low. Okay. I shout just to make sure you guys are awake. It's like a good preacher would. You see the people nodding off in the back pews, you get loud on them, bring down the fire on them. Pay attention or don't be here. It's going to work whether you're here or not. To the close in the low, I'm measuring that. Okay. Here's the lower quadrant level of that wick. When order flow is bullish, but there's an ice period right below this low ICT. What are you going to do about that? I'm going to ignore it. I'm going to ignore it. Why? Tell me. Tell me why. Well, because I spent some time teaching that these things, I don't want that. There we go. A little bit more punch, more visible. The dollar index has this wick and we're bullish. The next candle opens right there. Now watch. It's at some point after that opening, it's trading down to the upper quadrant. That's permissible. Absolutely permissible. And then it trades down to consequent encroachment. Remember, I marked that line here? It'll appear when I put the rectangle back. That's permissible. We do not want to see the body left underneath that level right here. But can it trade to there? That's a lower quadrant or the mid quadrant of that wick. This is the fair value gap, consequent encroachment. That's reasonable. It's expected to do that, but we don't want to see the body left underneath that. Same approach and application of the actual wick, which is this open down to that low. That's the midpoint of that wick right here. Can it trade down to that and it be permissible? Yes. We do not want to see the bodies left once the candle closes. It cannot do that. If it does that, guess what that means? You cut half the trade or close it if you're already long. Oh, you're talking about trade management. Yes, for free. But when I'm long and I use this strategy, where do I place my stop loss? You wait for this. Watch. Watch what's happening, folks. Watch. This wick that's diving down where everybody else would be freaking out thinking, oh no, the dollar index is going to crash. It opened here, and now it's trading down. It's getting ready to take out that low. The hell it is. No, it's not. It's just redelivering and filling the numbers. What numbers are you talking about, ICT? Spit it out, man. Here's your lower quadrant. That's as far as you want it to go. And here you go. No algorithm gang. Here you go. Ready? The price level in that lower quadrant is 97.522. Wow. Let's just take a look at the low of that candlestick. Oh, what does that say? Look, you're going to train your attention right up here, okay? Look at that, right? What's the low of that? Holy smokes! 97.522. You can't get better than that, Wyckoff. Volume profile my ass. You can't come close. And I'm hitting perfect. You might as well just call me Mr. Perfect, because that's who I'm going to be from now on. ICT's retired. It's Mr. Perfect, baby. You feel me? And then now what? What happens next? Candlestick opens up here. We got a wick again. Oh no. What are we going to do now? It's it's trading down. Look where it went. Look where it went. Yeah, look where it didn't go. Look where it didn't go. It didn't go to consequent encroachment of that bullish fair value gap. From here to there. Why is this guy shouting? This guy's too loud. It's too early in the morning for all this ruckus. Go back to bed. Go back to sleep. It's going to be all right. If you can get down the consequent encroachment of that bullish fair value gap, that's a good thing. That's a real good thing. New wick, new range. Order flows bullish. Rules to this stuff, folks. There's rules. Main one, there's an hierarchy. You're inside of this PD array on the daily chart. This is a bullish fair value gap. It can traverse down in the lower half, only wicks. But as soon as we place one down here like that, we have now limited the order flow in a way where we can see what's permissible and what's not. The next one opens up and trades down, goes right to the lower quadrant, only to the tick. On such a thin instrument like the dollar index? What? That's diabolical. There's no algorithm, though. There's no algorithm. That's buying and selling pressure, folks. That's buying and selling pressure. There's no doubt about that. You can see it clearly. New wick, grade it. Consequent encroachment of the wick and watch consequent encroachment of the bullish fair value gap. This is too much stuff, man. Give me an indicator. Go somewhere else. There's no Mickey Mouse mentorships here. This is all technical science. It fails to touch the consequent encroachment of the bullish fair value gap and trades to the consequent encroachment of this new wick, which is the range. We have to measure that. So what intel is it giving you as soon as that close right there happens? It's bullish. It's real bullish. Why? Couldn't get down to the low to close it up. So Chris Lurie, sorry. Then we get another wick, drops down perfectly to the tick that nobody ever talked about. Sorry, no pitchforks there, buddy, Mr. Jason. And then what it creates this close of this candlestick right there. Where in price action do we have another supporting event that supports that we have now staged another rallying point? What do you see here? Right when this candlestick closes, what's in place in price action? This candlestick's low, this candlestick's low, and now this candlestick's higher. So this is a swing low. Anything at this candlestick's open to low is a good buy. It's a discount. It's a real good buy. And then we open up on a new week up here. Boom. So now I'm gonna have to speed this up a little bit because we still haven't even got off of the dollar, and I got a couple other markets to talk about, and I got to do it in 30 minutes. So come on, ICT. I'm boring you anyway, so I mean, I don't know why I'm making you suffer, right? This is all bullish price action inside this little band of trading range. So to recant what it is I'm talking about here, we have smart money reversal, which is always a turtle soup premise to false breakout. Then low risk buy is here. Here you go. Ready? Listen, folks. Listen. Low risk buy is always, always, always inversion fair value gap if it offers it to you, which is this here. If there is no fair value gap over here, the smart money reversal forms the very first bullish fair value gap that forms. That is your low risk buy. If it's reversed, it's going to be your low risk sell. Always, 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 never deviating from that. Find that in Wyckoff. Find it in Elliott. Nobody is going to find that anywhere else. First stage accumulation. Wyckoff, are you taking notes, brother? The next fair value gap. It has to have an order block. It has to have an order block. Order block, fair value gap. First stage accumulation. Low hanging fruit, 70.5, and that buy side, and that inefficiency I told you about in September and October. It delivered to it perfectly. I'm probably scaring the hell out of some of you people who are brand new. Good. I want to make sure you're paying attention. Here comes your unicorn. The biggest run, the strongest run in a market maker buy or sell model. Here it comes. Ready? Well, look at that. What do you see there? What do you see? Inefficiency. Split it in half. Beautiful. Once it clips it, does it close inside this inefficiency? No. It closes up here. You as a trader are going to go short forex pairs like pound dollar, euro dollar, Aussie dollar when it's trading right in here because the dollar's going to go higher and it's going to reach for that buy side liquidity right there and then up here. Second stage reaccumulation, the unicorn. Up she goes. Now, hope I hope that you have learned something about my market maker models. I hope you learned. I'm not done. Don't get me wrong. I'm saying that I have given you a lot right here. And for some of you that are brand new, I've created so many questions and so many doubts that your head's swirling. And the fact that I shouted during this presentation makes you uncomfortable. You're probably a little bit nervous. And you probably don't want to come back. Trust your gut. If I'm not the right person for you, go somewhere else. I promise you, you'll be fine. But for the people who've been with me for a little while and you've been warming up to the idea of looking for market maker buy models and sell models and looking for the details that you can't find anywhere else, I just pulled back the veil. Sauce. Real saucy, right, kid? So anyway, obviously, we're looking at this liquidity in here, but we have to measure if this is a market maker sell model in here because this run to that liquidity we talked about back in September, October, it's hit it. Now we've pulled back. Using that same logic, man, to the tick, this guy, yep, to the tick, to the tick. All right, so we have this low, which is going to be perfect textbook market maker sell model draw on liquidity. Do we require perfect? No. So how do you classify low hanging fruit? the easiest level it's going to get to in the market maker sell model. That low up to the high, and then you're going to be marking the 70.5. And we'll do it with purple, just because I needed to stand out because there's a bunch of lines on here right now. I didn't do it right. Where's it at? Yeah. Just in my eyes, I'll tell you. I miss more than anything the youth in my vision because it just it ain't what it used to be. But here's 70.5. That means it's the low up to this high. That's the low hanging fruit. So in other words, up here, and grant me a little bit of latitude here, folks. I think I've earned it. The retracement back in here, which is reasonable, would be this level here. We've did that. Now, if we close below it, it indicates that we're likely to dig into this eventually. Doesn't mean it's going to be a straight shot. It just means that I would trust that it's likely to continue doing that. Okay, so hopefully it makes a little bit of sense for you. All right, now finally, oh my goodness, finally, ICT gets to euro dollar. All right, so euro dollar, I got to go through a bunch of this stuff real quick. I apologize. It's going to seem really probably disrespectful in terms of the amount of time I spent on dollar, but it wasn't just teaching dollar. I was You're basically quantifying and qualifying all the things I said in September and October that delivered into your charts too, real time. I had no control over price, but you see it in hindsight now. And I taught you how to make models, how to use parts of a market maker buy and sell model as your fractal. What does that mean? If you're a turtle soup trader, you're using smart money reversals as your entry mechanism. That's the premise that you're trading under. That fractal part of a market maker buy model or sell model is the smart money reversal. The low risk entry, okay, that is a inversion fair value gap or first presented fair value gap after the turn or the curve begins. Okay. So it's one or the other. If there's an inversion fair value gap there, you use that one. If it's not there, you're going to take the very first fair value gap, and that's going to be your low risk entry. That's a fractal. That's the cookie cutter of that model or that market maker buy model. It's one little piece of it that you're using to frame the whole idea why you're taking a trade. Or you're waiting for first stage reaccumulation. I'm sorry, accumulation or distribution. If you see that form and you missed it, or if you really want, a lot of ammunition behind your next setup, wait for it to deliver. Let it pan out. And then the first retracement back down into the inefficiency is going to be what? Second stage reaccumulation in a market maker buy model. That's the unicorn. That's the big bang for your buck. That's the setup that just goes off to the races. It's so fun. It doesn't wait around. It doesn't delay. It's just real quick and it runs to that liquidity. Each one of those is a cookie cutter. Each one of those is a fractal part of the market maker or sell or buy model. Each one of them is a component. You need to be aware of all of them if you're going to be using the turtle soup idea of entering at the smart money reversals. Why? Because you will have more conviction behind holding the trade because you know every stage of my market maker model. And you won't be scared when it's retracing against you. You know what it's going to likely do. If there's wicks, grade them. If there's inefficiencies, grade them. Consequent encouragement should be respected. The bodies are allowed to only stay in the upper half of the inefficiencies or gaps or wicks, but they can traverse by their wicks down lower and scare you. If you don't have this logic, you'll get nervous and close trade. But if it drops a body below consequent encouragement of any one of these PD arrays and you hold a position that affords you to do so, cut half the position. Simple. Simple. But as soon as that dollar index, I forgot. I'm sorry. Let me go back. See, this is where I would have edited and pretended like I was still in the chart talking about it if it was a pre-recorded video. If you entered long here and your stop loss is below the low here and you're that working class hero model trader, As soon as it creates this swing low here and this candle closes, your stop loss can be brought up right below that low. And now you've locked in whatever that profit would be. Unrealized potential paper trading profit, right? Hint, hint, nudge, nudge. So same thing here. Once this creates a swing low and it rallies up, then you can move the stop loss from under here up to there, because second stage reaccumulation on a market maker buy model should ever, never, never be traded back down through once it forms. If it does, you're wrong, and you want to be stopped out. You want to be out of it by then. Second stage reaccumulation in a market maker buy model never gets a stop hunt on it. Never. It never does. If it does, you're on the wrong side of the marketplace and you want to be out. I said it twice now, so that way you know. That means it should be written down in your journal. Second stage reaccumulation in market maker buy model never has a stop rate on it. Second stage redistribution of a market maker sell model never has a stop rate on it. Never. It's too one-sided. It's in a hurry. So that way, if you're positioned ahead of it, that means first stage accumulation, low risk entry, or you were fortunate enough to trade turtle soup long, it helps you manage where your stop loss is. And that's many times why you see me put stop losses in places where I know it ain't going to go. Why is he so confident that it's not going to go? Because I'm using this logic. I'm using what I'm teaching you here, but you don't want to take notes. You don't want to test it. You don't want to go back and look at your charts because that takes time. There's too many football games on ICT. You don't understand. I only got 2 days a week. I had the same days that you have. I stayed up and went to work with 2.5 hours sometimes no sleep. Worked 13 hours, came home and did it all over again. Dr. Pepper, Mountain Dew, all the worst things to be drinking, but I was filling myself with caffeine because I wanted to learn this. I found the energy. I made the time to do it. So please don't complain to me. Don't talk to me about what you have against you. You have what you're permitting against you. Okay. So now let's get $1 so I can get done. I gotta eat some breakfast, man. All right. So here's the daily chart on the euro-dollar. I hope that was beneficial to you. By the way, I gave you a whole workshop right there. Could have charged you $2,500 right there. So I would have never paid it, ICT. I would have waited for the Telegram crew to put it out for free. I know. So we have this inefficiency here when it took out that low. Watch, folks. Here we go. Ready? Sell side. It drops down. Wow. That is what? That's a smart money reversal. Original buy side here. Okay, wonderful. It drops down and comes right back up. The gap here is a inversion fair value gap. Why? The premise is the market went down to take liquidity. What liquidity? Sell side over here. If this forms, this right here, always will behave as an inversion fair value gap. Yep. See, volume profile boys, they got to wait for these volume things to form. They got to wait to see what the point of control is. See the difference there? You got to wait until it tells you what it is. I'm telling you where my shit is going to form before it happens. The logic is always there. It's always there. Always. Never deviating. Never. There's no cherry picking. There's no form fitting required. It's the same stuff. Time based delivery. Over and over and over again, it's the same stuff, repeating over and over and over again. Because you haven't studied, because you haven't put your time into it, you don't trust it. And that pain of, what if I waste my time? If that's how you feel about it, don't watch any of my stuff. It's simple. I'm going to protect you right now and tell you, don't do it. But it's going to take you some time looking at it. It's going to take you some time picking up the information. So we have the drop down in here. First fair value gap there. You can buy that. That's institutional order flow entry drill. That drop right here. Rips another one here. Order block, draw that out. Hits it again. All time distortion. And then it rips higher. buy side imbalance, sell side inefficiency. Second stage, reaccumulation. First stage, accumulation. Low risk entry, smart money reversal. Original consolidation or the opposing buy side, liquidity, hits it. Then it drops down, okay? High to low. 70.5. Reasonable. Did it go down to it? Yes. Did it go lower? Yes. Where did it go to? That inversion fair value gap that was framed on the basis of this market maker buy model. It's not pretty, folks. It's like that cookie cutter that gets pressed in and your kid tugged on your arm as you're pulling it up, and then all of a sudden it's all stretched out and it doesn't look like that perfect 5-point star, or it doesn't look like the Santa Claus outline or the Rudolph, whatever that cookie cutter is supposed to be shaped like. It's a little wonky now, but it's still a cookie cutter. You could take that cookie, even though it's misshaped a little bit, you can put it in the oven. It's going to cook up just like every one of those other cookies. They ain't going to taste any different. Okay? They're still a cookie. Same thing here. Market maker buy model. Now we're in smart money reversal, low risk sell, inversion fair value gap exists. That's the one you use. Breaks down, imbalance, first stage distribution, second stage redistribution, 70.5. What level below these relative equal loads would you use? Inversion fair value gap. Boom. And now we're getting a reaction off of that. You see how all these things blend together? They blend together, not making a whole thesis on one individual candlestick. You have to blend it together. If you want the results I'm showing and what my students that are making millions of dollars, and for the yahoos out there, oh, you got to only have a handful. Dude, you only have no idea how many people all around the world that are now 7 figures, 8 figures, real money profit. Not, I got $1 million in funded demo accounts. That's not funded anything. I'm talking about my students that have made millions of real dollars, 8 figures in the bank, spendable, not demo accounts, not prop demo accounts, unfunded. You ain't nothing. How much money you got? How much money you got in the bank? That's what you're funded with. I got 8 figures. Baby, they're all lined up. Lined. And they're all using this stuff. This stuff that doesn't supposedly work. Supposedly it's rebranded. I'm making a mockery of all that stuff today and having a lot of fun doing it. So, anyway, you want to blend what I said about the dollar index with the euro here, and you'll be able to see a lot of the things are just a mirror image. Everything is a mirror image of what was called for and what was delivered in dollar is going to be the mirror opposite on euro dollar. Quickly moving on into, because I have a lot of markets to cover and I only have a little bit of time. Here's the British pound or cable, and market dropped lower, had a nice little inefficiency there, hit that. This wick, before this candlestick formed, this was the lowest reaching wick. So you want to grade that. Okay. And in here, you can see how the bodies were unable to get to the high end of it. They wick through it. It's a little bit of something to measure of like a time distortion where it can color outside the lines a little bit, but you have to do what? If you're short, you would collapse half your position and look to another future PD array to reestablish that same portion of your trade. No inefficiency here, but we do have a wick. You can grade that if you want, but it breaks lower, trades back up into this, which was inversion. I don't have these levels on here because this is the first time me pulling up cable since I put all this stuff on the chart back then. All this stuff here would be anchored to this inversion fair value gap. And you can see, I'll draw them real quick. While dollar is bullish, cable or pound dollar is going to be bearish. And you want to do this on your own charts, get your own evidence. If you zoom in here, you can see consequent encroachment, Can't get to it there, can't get to it there, and the bodies are left even outside of that inversion fair value gap. So that is what? Is that bullish or is it bearish? Or really, really bearish? Really, really bearish. And sell side's below here, and it tanks down into it there. So cable was actually very nice in terms of what it was willing to do and what the difference between that. Why is cable a heavier sell or short? Or why was it? Let's say it that way. Why was cable a better short? If you look at the euro dollar, look, get a mental picture of this, okay? And then look at euro. See how tight the declines were? Very stunted. In other words, they're not allowed to just really reach out and stretch like you're stretching pasta out and making noodles and whatnot. It's not given that much opportunity to move lower. It's real tight and stilted. Whereas you go back to cable, it's allowed to rip lower, rip lower, rip lower. All the down close candles are much larger, much more prominent. So it's not just simply enough looking at old highs and lows for SMT studies, but it's also how much, if there is no SMT, how much are the individual candlesticks allowed to trade and elongate when you're looking at one directional ideas. For instance, if dollar's bullish, euro and cable should drop. And if there is no identification in SMT, in other words, if you can't ferret that out in price action, then you're forced to only look at the delivery of price. How much are the daily ranges being, or if any time frame, it's not just simply limited to the daily chart, but what the individual candlesticks are in deference to the time, or not time, but the direction. For instance, if you're bearish on Forex pairs like euro and cable or pound dollar, while the dollar is bullish, you want to be looking at the down close candles in the two. So if there is no SMT and you can't ferret out which one's the weaker one, just simply look at how much of the ranges are allowed to perform in euro and cable. And the one that has larger, more prominent down close candles, that's indicating that that's the one that's the weaker one. So the next sell side opportunity that you can draw down into, use the first premium array that forms and get short there and just ride it out. All right, so that's the business there. I was asked about crude oil. I don't do much with crude oil, to be honest with you. Um, and I wouldn't do anything with it right now. There's nothing in here that I see as a viable setup. It's just in the middle of an area where I wouldn't be participating. If it did a displacement lower again, like say it broke this low here, I would take the very first fair value gap that forms and make a run for these relative equal lows. That's the only thing I would be willing to do right now. Anything on the upside, I just don't. I'm not interested in that. Wouldn't take anything on it, but I would want to see something kind of displacement lower, as long as it doesn't take out that low yet. So displacement lower, the first fair value gap that forms, I would venture to study it. Okay, let's say it that way. I don't want to encourage you to take a short, and if you get hurt, and you can come back and yell at me. But that's what I would see as a setup that would potentially be there for me if I were forced. I had a gun in my head saying, trade crude oil or do nothing. You can't breathe. You can't exist without doing this. Okay, well, I would wait for a displacement lower, fair value gap short that has to form. The fair value gap has to form above this low. And then I would aim for that low right there. And that would be it. I'd be done. So that's my opinion on crude oil. Gold, and I apologize if I'm going too far, too fast, whatnot. Gold, boys over there on the exchange saw my post. Here we go. All right. So if you look at the X post I made, people were asking me what my opinion was about gold. This inefficiency here, I had, let me move it so you can see it. I said, if left unfilled, new all-time highs were likely. So I would have preferred it not to trade down in here. So because it has done that, we may have a deeper retracement in mind, which is why I was telling you when we were over here to consider taking some profits on gold. And then we went all the way down here. We're inside this inefficiency. Yes, it offered a little bit, but it only went up into this sell side and bounce, buy side inefficiency. It wicked through it a little bit, and that was simply using the quadrants here. So this wick, let me take this off just for a second so you can see what I'm doing. That wick is longer than that one. You see that? Let me take this, move it over here a little bit. Can you see and agree that this wick on this candlestick right here is longer than this one? That's why I'm picking this one. Okay. And now what's the useful information it's providing? Let me go back and show you. When price was down here, it can trade up into this inefficiency, but if it wants to trade beyond that, now this is what you want to have in your notes for when you're having imbalances like bearish fair value gaps or bullish fair value gaps, even the suspension blocks. If the block is formed, or the inefficiency rather, is formed on a wick, not a stubby-ended candlestick body. And what would that look like? Something like this. That's a stubby-ended bottom candle. Or it could be the opening and low being the same price. That's not what we're seeing on this candlestick here or this candlestick. You see that? It's a wick on both instances right there, here and here. What I do is when I'm below that, and if it can trade up into this inefficiency, it's defined with that volume imbalance. You see that? That's why I'm using that area there up to this candlestick's low. That's simply the bearish fair value gap. But if it's formed with wicks, this wick clearly says it's formed on a wick. And then if there's a wick to the left of that that is in the same range that this is being shared in, this wick is not the importance. This wick is the importance. So you want to grade that. Okay. And then this candlestick's upper quadrant level comes in at, I'm sorry, 4249.9. And the high of that candlestick comes in at 4250. So one tenth of a point. That's real good, folks. That's real good. I'm certain that Wyckoff probably had that, and Elliott Wave had it probably in their books too. But then the market goes lower, and then we hit the lower quadrant right here. The high of that candlestick comes in at 4215.1. And what is that price? 4214.0. That's pretty tight. And we're looking at daily ranges. So that's very tight on a very highly manipulated market right now at the time. And then price came back down into the range. I preferred if it were going to stay open like this, then higher prices and trade back up here. But now because we've traded back in here, that right there immediately removes my initial willingness to want to see higher prices. And I would be more inclined to wait and see if it wants to clear up any of this here. Otherwise, there's nothing in here that it needs to trade back into. No PD arrays of importance that I like. It could hit the order block opening of this candlestick candle price, which would be its change in state of delivery. That would be the last line of defense. If it were to trade down and close below that, then we're probably looking for, a drop below here for sell side. And there's a small little inefficiency right in here. If it were to do that on an exaggerated basis, it could get down into there. All right, so what else? I covered that. Gold, crude oil, I covered the Forex pairs, dollar index, I gave the lecture. All right, and now Bitcoin. I don't trade this stuff, folks, and I see some people making reference that I'm charting it on Bitstamp. I don't know what exchange to do it on. I've always simply used this one, okay? And if there's a better one to do it, I don't care because I'm not going to trade it. But there's your Bitcoin, and I gave you the inefficiency, and I'm getting a lot of hate mail. I guess they think that I'm talking it down. I'm not talking it down, folks. I don't trade this stuff. I don't participate in it. I have no skin in the race, zero. But I know there's a lot of my students that I guess they want to arm wrestle me. And I'm not in here trying to arm wrestle my students. I'm just being honest. I don't do it all the time. But when I feel inclined to talk about it, there's usually a significant price move. And I told you right here that it's going to explore below 100,000. And the technical reasons are all here. And then the one I showed you on the lower time frames. And this inefficiency here certainly looks like it's trying to get down to it. Okay. I'm not causing this to go down. So please don't get mad at me. Please don't send me death threats. I'm not worried about it. I have a lot of brass friends, and I'm not causing it to go down. So if you're a brand new trader and you're losing money, or if you're a present trader that's maybe made a lot of money, and you're looking at how many people follow me and you think that has influence, I might have influence, but I'm not causing it to go down because there's no buying and selling pressure. Okay. I don't believe in that. So you can sleep at night knowing that I'm not causing the market to go down. I'm just predicting that it will, and that's all. That's it. And I've been wrong a couple times with Bitcoin. I still think it's going to go to zero. And I mean that. 100%, 100% mean that it is going to go to a point where it's no longer there. Just like pork bellies, you can't trade them anymore. Bitcoin is going to be like that. It may not happen in my life. I'm 54 coming up in 2026. I'm not promised tomorrow, but eventually, I don't think Bitcoin's going to be around. And you can argue with me all you want. I don't care. I don't care. I don't care ultimately. Okay. You can give me all the reasons why because you are emotionally and psychologically and financially invested. I'm not. So I'm objective about it. I don't have no fear of being wrong, and I don't have anything if I'm right. So I'm not trying to talk it down and using influence to make money because I'm short secretly. I'm not. So I really want you to understand it because a lot of the crypto bunch is really, really crazy. Like not as bad as they used to be, but some of them are just really fanatical, and they assume that I'm trying to create fear, uncertainty, and doubt. What's it called? FUD. I'm not trying to do that at all. I just know that this is a circus act type of market. It's extremely exaggerated, and the few times that I've talked about it, I've called some pretty nice moves. I said that it would probably top out around 127. Worst case scenario, but in mentorship, they can all come forward and tell me I'm a liar if I didn't do it. There's receipts. All they got to do is screenshot it and come forward and say this is what he really said. But I said Bitcoin can go 125, 126 ish. Worst case scenario, 127. There it is, and that's pretty much what it go to. What is that? 126.272. Okay. So behind a paywall, that's what I told students. That's the highest worst case scenario. That's what it would do. And I said there would be a large pool of liquidity at around 75,000. That was sell side. And that was your last real good buy. 74,434. And then we had that. Okay. And I put that on Twitter. You can see that. So it is what it is. Like I said, I don't talk much about it, but when there's a whole lot of potential of a move, then I will. And it's not because I want you to get rich or deny you of profits if you're doing the opposite of me. I'm trying to protect you. That's all. That's all I'm doing. I can just see when there's a great deal of manipulation that's available to them that make these markets. I, I I would feel bad if I didn't talk about it because for years I watched it go on. And even before I stepped out on Baby Pips, I watched these people on Baby Pips pretend to know what they're talking about, and they had no idea what they're talking about. And then when I stepped out there and said, "This is what really goes on," that's why I got popular as fast as I did because what I would say happened, and they saw it, and I was really consistent with it. And when you have people in this industry that are trying to find their position or status or carve out an identity for themselves because they want to sell something, um, people like me, I'm going to catch a lot of that. And it's why the expression is heavy as the head that wears the crown. I don't consider myself the king. I don't act like the king, but I do instigate a lot of conversation. And sometimes the things I say are inflammatory for the purpose of for conversation. I want exchanges of ideas. And I'm not afraid of people saying what I do or don't do is not the right thing because the conversation still invites new conversation. And people come to me like this, where it's free. I'm not making any money off of it. I'm talking to you on Twitter Spaces where I'm not monetized. I invite all of you to take my stuff and put it on your channel, not my lectures, but all the Twitter Spaces. You're welcome to take that stuff and put music behind it. I'm really done well. Like it sounds like Alan Watts stuff, which is crazy. But the idea of backlash I get, I don't lose any sleep over it. You shouldn't. Don't feel like you have to defend me. Okay, find your own evidence in what I teach, and then laugh at them. If they come at me hard, just laugh at them. Just understand that they have emotional reasons for them to do what they're doing, and many times it's emotional and financial because I'm probably hurting their business by me doing what I'm doing. People are flocking to me where they can get it for free, and I have students that have their own little boutique shop of what they do, and I hold respect for them because they don't bite me back. Even though I say what I'm saying here, they could cringe and say, "Man, shut up, ICT. I'm trying to do this." I'm not coming at any of them. I'm not coming at any of them because they don't come at me and say blah blah blah. Blah. But there's been a few of them, Omar. They they're trying so desperately. to try to find a way to stand apart, and they can't come outside the shadow. It's too big, and it's not necessary. Just bloom where you're planted. You don't have to. You don't have to be bigger than what you are. Just be content with who you are. And if you can do that and live well in your own skin, you won't have all the baggage that comes with problematic trading, because all that stuff does is bogs you down. You worry about all these things, these superficial things that have no bearing on what it is that's going to make you money. And if you're in this industry, you should only be here to make money. Everything else is a distraction. Everything else, if you're not learning from someone that's going to invest in you, insight that's gainful, profitable, and proven to work, then you're wasting your time. And all I am asking you to do is just weigh out whether or not what am I doing? Am I wasting your time, or am I giving you something that works? I don't know. You tell me. So let's go to Dow. I don't usually talk about the dirty 30 much, but I do have to get through this because I'm 5 minutes past my deadline. I promise you it's not going to go 4 hours. I promise you. And I know you're probably thinking I'm going to, but I'm not. And my cup of cocoa is cold. All right, so here's the daily chart of the Dow index. Okay, and for the ideas of usefulness, what is the point of me even bringing up the dollar index? I'm sorry, Dow Industrial Average at all. I treat it like the dollar index. That's why I said it. I miscalled it as a dollar just a second ago, because it's used as like a barometer for me. As an index trader, I'm predominantly interested in the Nasdaq only because it's exaggerated. All of its price moves are exaggerated because it's thinner than the S&P. S&P, big boy. There's a whole lot of um, stocks in that average versus the 100 that makes up the composite index for Nasdaq. So you have 500 blue chip stocks that make up the S&P 500. So when that moves, it's a better barometer of the breadth of the market. It means how much real buying is taking place in the marketplace can be better measured with the, I guess, the participation of the S&P moving up or down in concert with what the idea of bullish or bearish is. Now, with that same idea and thinking, what do you think that would mean for the Dow index, the Dow Industrial Average, rather? It's only comprised of 30 stocks. So, you know, if you only have a composite index of 30 issues in the stock market, one stock could make this average go crazy. One stock can cause it to go way up. And if a few of them out of the 30 go up, it's going to be wildly out of character for the other averages. So that's why I don't trade this one, because it can be a little wild, a little unruly. Okay. The Dow's kind of like that girl that you couldn't get at the end of the bar, but the other one at the other side of the bar that no one's talked to, you've had a little too much to drink, but you don't want to go home. That's the one you're going to ask out, because you're probably going to get it, no problem. That's what she is. She's the dirty 30. She's the white night. She's a one night stand. She's not. You're not going to take her home to meet mom. Okay, ladies in deference. You're not going to. You're not introducing this guy to your parents. Okay, but you're just going to go in there and look for a short term fling. Okay, real quick, scalp, get out, and done. That's my perspective. That's the analogy I've always maintained with it. It's just a simple usefulness for intermarket relationships. Like, I want to see it for Dow theory, supporting the idea of whether or not the market breadth is in fact good across all averages. But I have the least affinity or importance placed on the Dow. So if the market, let me make it very clean and clear for you. If the market does something like this, say we're in a bullish market condition, and this is the Dow. Okay, and we have a low that's been taken out, and say the S&P comparably does this, and the Nasdaq does that. If this is the Dow in the middle, S&P above it, and the Nasdaq is lower, in the time I'm expecting the market to be bullish, okay, the S&P has more stocks in it than the Dow and the Nasdaq. So by sheer brute force of how many contracts, or not contracts, but companies that are in the average or index that makes the S&P up. If it fails to make that lower low here, while the Dow does make a lower low and the Nasdaq makes a lower low, this is, by theory, Dow theory, is the basis of SMT. All I did was incorporate that idea and some ideas I got from Larry Williams, and I've always said this: I didn't invent SMT. I just named it because it's like a smart money concept or technique or tool. And it's always, I've never settled on what the T stands for. It's always been interchangeably technique or tool, because that part it's not mine. I never claimed ownership of it. I didn't care about it that much. And sometimes it's useful and sometimes it's not. But when the underlying premise is there for the market to be bullish, and you get a criteria like this, that really many times signals the low, and that would be basically a turtle soup long below that low for Dow, a turtle soup long below that low for Nasdaq, and this is simply just an optimal trade entry for the S&P. The crack in correlation, meaning at a time when they all do not agree, when it's already bullish, when this failed low below that low, in other words, this is a divergence between these respective lows. If the S&P is doing this, then we're really bullish. If the premise is underlyingly bullish too. And what would that look like? Remember when I was showing you with the dollar index on the daily chart, and I showed you how to frame the dealing range it's in? And then once that low was taken out, we entered this range that is the beginning and framework of a buy program, when everything for my market maker buy model is going to form, all facets of it: the low risk entry, reaccumulation, second stage reaccumulation. All of those are going to be inside that range. Inside that little range of price action, when the buy program should manifest all the facets of a buy model or sell model if it's bearish. If you see this criteria in price action, it further presses the envelope of how fast and how hard it's going to go up, because it's really indicating on all checkpoints that it's going to go up. Now, I do not, this is really important, I do not share the same affinity for being wildly bullish if this one is the Dow and this is Nasdaq and this is S&P, or vice versa. If the diverging average is the Dow, I don't care. There's many times where you'll see a divergence in the Dow, and you might look at that and say, "Oh, it's a SMT divergence, and it's going to cause all the averages to change." I have lost a lot of money trying to do that initially, and I've learned by lesson of money leaving my hands that the greater importance is placed on the S&P most, then the Nasdaq. I will take a SMT divergence or Dow theory, converge, all the averages being confirmed with one another. In a perfect world, every low should be matched with the Dow, the Nasdaq, and the S&P. But there are times when one of those averages diverge. And the importance I'm trying to place on an emphasis on is, if the divergence like this is forming when you're bullish and this is the S&P, that's kind of like a loaded deal. If it's the Nasdaq, I have affinity for that one, but it would be better if it would have been in the S&P. Sometimes both the S&P and the Nasdaq fail to do that, and the Dow will make that lower low. Does that mean the Dow is telling you it's weaker? Some of my students erroneously have thought that, because they're rushing to believe just because there's a divergence or supposed divergence in the averages, they think that that's enough information. It's not. So hopefully I've corrected you and recalibrated your expectations as it relates to SMT or looking at the averages in this capacity. All right, so let's get this off. All right, so come on now. All right, so right away, let's assume for a moment that we're in some kind of a deeper retracement, and we might be, folks. The Dow looks real clean right there. You see that? So whenever I see stuff like that, I like to annotate it. I'm not trying to sell it hard. I'm not a Dow trader. I'm not going to be shorting it. I don't have any race. I don't have any money in the race on this individual average. I'm a NASDAQ trader. Very, very rarely S&P. I mean, I'm talking rare, but it's usually on the basis of someone saying, you don't ever trade the S&P and your stuff doesn't work in the S&P. So of course, you know what I'm going to do. So The sell side liquidity resting below here, it's validated and qualified as a potential candidate because the low that's anchored here has a higher low to it. So that's how we look at relative equal highs and relative equal lows. The most recent low with relative equal lows needs to be higher than the one you're anchored to. Because they're close proximity and same price. The one slightly higher is a validation that this is likely to be attacked at some time. It doesn't mean it's going to be a straight shot right to it. It just means that this is a likely condition that could draw to over time. So it's an intermediate term perspective or analysis. You see this gap right here? That right there. You want to have that on your chart and treat that as inversion. Why? Because we traded down below it. It has passed down through it here and then up here, and now we're down below it. So we have done the work of delivering the absence of buy-side delivery. Now, buy-side delivery is simply the market moving higher from one point to a higher point. Sell-side delivery is simply just the market moving from a high point to a lower point, and it leaves bodies across both directions. What does that mean? If this gap is framed with this candlestick's open, this candlestick's close, in essence, this is the range. And that could have made $2,500 per head with this workshop here. It's missing. Watch, let me move this out of the way. See, it's got a little bit of a wick here and it's got a little bit of a wick here, but they don't touch. There's no kiss between these two. There's a small little gap. This is a common gap. Okay? Common gap. I didn't invent common gaps. I didn't coin anything for a common gap except for I call it a vacuum block where there's an absence of any real price action there. Zero. Okay? That's a, I guess, imbalance. There's nothing there. Or what was the word I was looking for? Oh, yeah. Chris Laurie said, it's a liquidity void. Okay, well, this portion of movement here with this big up close candle, that's not an inefficiency. I'm sorry, it's not a void. It is an inefficiency. It's inefficient in sell side delivery. It's a buy side imbalance. So it's one sided up move, but it's deficient in having sell side delivery. So it needs to have what? Sell side delivery, which is a pass back down over top of this range. This portion right in here is an actual absence of both buying and selling. Nobody did any trading between this candlestick's wick high and this candlestick's low. There's a real vacuum of any trading there. This is a liquidity void. It's void of any liquidity because nothing took place there. So that's a real improvement in terms of terminology. But because there's no bodies left in these two price points here that I'm framing with the candlesticks closed and candlesticks open there, that right there is a volume imbalance. But it's encapsulating a vacuum block or common gap. Okay? So it's really, really important you understand that. When we saw price drop down and laid the body down over top of this candlestick's close from this candlestick's open, that's these two trend line segments I've highlighted here. Let me make it a little bit bigger in case you guys can't see it well. Thank you, ICT. Thank you. See, I can hear you. You think this is a one-way conversation. It's not. I can read your mind. He's in my mind. So this opening price and that closing price, that frames the volume imbalance. So when the candlestick comes down like this, stops, the next candle opens and stops right there, we have done what? We have delivered sell side delivery. It offered price on the downside. That is not efficient anymore, or yet rather, because it has not offered buy side delivery at all yet, because it went this far, stopped, and closed there, and then opened up here. Well, what about the difference between this candlestick's wick high and this candlestick's low? There's nothing in there. And there's no bodies in between the close and the open of that price. It's a volume imbalance, not volume like you're looking for volume profile. Just because it shares the same word is not the same thing. There's no volume offered at all on a candlestick basis. Okay? If you're not using time based candlesticks, you're not looking at price the way the algorithm delivers it. All these Renko bars and algo bars and everything else you want to call it, range bars, nonsense. Nonsense. And I'm going to flame people up and they're going to be mad. They're going to come at me. They're going to create new videos about me. They're going to come at me in their sock puppet account. I don't give a shit. Okay. I don't care. I don't care. But this is sell side delivery. Now, what does it become? All that done, all that has done is turn this volume imbalance into now a sell side imbalance, buy side inefficiency, or SIBI. What? Yes, it's changing its character. What's character? The volume imbalance now becomes a sell side imbalance, buy side inefficiency because it's only sell side offered. What is it lacking? Buy side delivery. When does that come? Here. Candlestick comes inside the range that's shaded here. It closes. The next one opens, trades down a little bit, and comes up here and closes outside of it. So now we have sell side delivery that looks like this. That's sell side delivery. It's the same as a SIBI. Same thing. At this point, that's all it is. So what is it lacking? Buy side delivery. So you know that the market's wanting to do what? It wants to go higher, and it's going to lay down like a paint roller. You ever painted your house or watch a painter do it? I watched them paint my house, and I had to pay $45,000 to watch them paint this house. No ceilings were painted, just the walls. And I'm like, I could have did this. I told my wife, I said I could have done it. No, you couldn't. You think you can do everything. Listen, you're talking to ICT woman. You better watch your mouth. So the sell side imbalance, buy side inefficiency is lacking what? Buy side delivery. So that means it's going to roll that paint roller up the wall here where it takes it down like this. Well, then you're going to take the same paint roller and roll it right back up to make sure the paint is done what? Efficiently delivered inside of that volume imbalance right there. And you see it happening right there. So now in this area, what was inefficient on both sides of the equation, buy side and sell side, it became only efficient on buy side because sell side was offered here. So the paint roller was drawn down to put paint from this candlestick's open and that candlestick's closed. Then it rolls right back up. So now this whole area is become efficient, but it's an old inefficiency. So if we trade down below it like this, it needs to be viewed as a potential what? Inversion fair value gap because it can reclaim each one of these positions of inefficiency and the original area over here of inefficiency. Long story short, we cut through candles. We don't look at liquidity voids. We look at how price has been offered and how it was delivered. So if it were to trade up in here, as long as it stays below the midpoint, it could be bearish and send it lower. I forgot what we're even on. Okay, yeah, it's the Dow. So anyway, this low here and this volume imbalance, I like both of them. That might be a little mile marker as well. This area here, you want to shade that and extend it forward because that might act as an inversion level. Once it trades down to it, if it goes down below, it comes back up. You could actually offer an opportunity, much in the same way as an inversion fair value gap. It's a change in the character of its original purpose when it was placed in price action. This wick, because it's the lowest of all these, you want to grade that. I'll just throw it on here just for completeness sake. I'm not going to come back to the Dow at any time in the future. So just make sure you're doing this on your own chart if you're interested in watching it. Um, that is easier done like this. Hmm. Can you tell I missed you? Can you tell I missed talking to you? He's going to stay here for 4 hours. Watch. No, I'm not. I'm actually not going to do that. All right. So here's the high, the upper quadrant, consequent encroachment, the lower quadrant, and the low. So if it's going to go to this level here or trade down into that sell side, what would you like to see as it relates to this wick here? Wouldn't you want to see a body close below the consequent encroachment? Right. You're learning. See, if it doesn't do that or can't do that, then it's going to require more time, or I'm probably wrong, and it's probably not going to go down here anytime soon. Okay, but I would venture to say that's probably likely, and that's not to inspire you to put money into the market to do that. Okay. All right. So now we can get that off here. I don't know why it popped up. The go over to the S&P real quick. So ES December contract Z2025. All right, you see the divergence between the two? Let me show you again. See the Dow higher, and then we have ES lower high. And because it's the S&P, not the Dow, everybody was talking about, man, look how bullish the Dow was. It's shaking off everything. It's so strong. It's going to the moon. And then now what we're doing. I love seeing that on social media. That's what I use social media for. That's why I go to live streams from people that are not my students, obviously. They have these different ideas and schools of thought. And usually when they're very opinionated, I love it. I love it. I love it when they do that because it tells me their character is they're going to smart mouth the marketplace when it looks obvious and it's already happened. And when it becomes real, really sharp, bullish, and they can talk, oh, look, it's going to go to the moon. Look how everybody's losing their rear end because they try to short the Dow, blah, blah, blah. I love that. I love that because that's indicating the purest form of market sentiment there is. You're getting a goober that doesn't do anything and they're only reacting. They're reactionary. They're responding emotionally to something they probably didn't even profit on. And they want everybody to share in their exuberance about what took place that he made no money on. So you're getting peak delusion. You're getting peak retail perspective for free. And that's why YouTube is wonderful because they're giving it to you, but they think they're smart at that time. They think that they're talking shop talk. Shop talk is, somebody that's in a field, like when you went to work. Okay, when I was a young boy, I tried doing block laying, brickwork. That's hard stuff. And to hear these guys, jawbone each other, really, really ribbing them up, and they did that to me too. And I got thick skin, and I earned it from all the things I was raised around. But there was a couple times where some of the guys that were coming there, they were greenhorns like me, and the only thing we would do was we would grab the block at the low levels and hand it out to the guys on the higher scaffold. You have to build shoulders and muscles and lat muscles to build that up, and if you come in weak, they're gonna razz you all day long. And some of these guys literally started crying and left, and it was kind of sad, really. But I took the lumps and I earned my paycheck. Shop talk from people that aren't doing any work is just silly, and to hear them beat the chest and they talk smart, they talk real smart at the peak of when moves are taking place, you can pick the frauds out easily because they're going to talk when they should be quiet. And when they talk, it's wrong. And that's why YouTube's perfect. That's why it's perfect for live streamers that don't know what they're doing and they're giving you all the evidence to fade them. They're doing it all the time. And all they're trying to do is get attention for ad revenue. They know they're not a good trader, and I know they're not a good trader either because some of the experience I have, I can spot them a mile away. And once you learn what I'm teaching you, you'll be able to spot them too. And it's not meant to troll them. I don't troll them. They don't even know I'm watching them, but I'm using them. I'm using their perspective because it's limited to a neophyte. The worst potential opinion about these markets, that's what I'm looking for. And if I can take that time when technically everything's lined up for the opposite to happen based on what I teach and what I trade with versus what they're talking about and bloviating about, who's going to win that arm wrestling match? Clearly, right? Come on. So the difference is now the S&P said, I'm not interested in making that higher high. When the retail crowd was saying, look how strong the Dow is. Yeah, look how strong it is. Now it's joining. My stomach's growling. If you heard that, I apologize, but I'm fasted for now 20 hours, almost 20 hours now. So I have to get off here and eat. I'm 27 minutes over time. I'm messing up, aren't I? So the divergence between the Dow making a higher high and the S&P not making that higher high, and just for clarity's sake, you can see it again. Dow made a higher high. Everybody was, wow, look how strong it is. Seasoned traders were not exasperating about how wonderfully strong the Dow is, like that was anything in terms of bullishness. ES said, I'm not interested in going up there with the 500 companies that I'm tracking. And look how it's performed. What is this? What is that? It's a volume imbalance. You want to have that on your chart. If you're an S&P trader, you want to break that down, grade it also. That means you want to measure the quadrants of it. You guys still with me? You learning anything? Probably put a lot of you to sleep. So that's what you would have. And you want to take that and view these levels on a lower time frame chart, and you'll see how the influence is there. Another volume imbalance, you want to have that on your chart. Anytime a volume imbalance occurs on higher time frame dailies, you absolutely want to have that on your chart. And why I'm using the orange shade that I usually use for inversion, this is for your notes. The candlestick here It's the low of that volume imbalance. It closed right there, and then the next candle opened up here. So the characteristic is what? Bullish. So if it trades down below it, it's going to act as an inversion if it can come back up and touch it. Same premise here. We closed here and gapped up higher. So that's why I'm shading that color. It tells me and communicating to you if price were to ever trade up into these levels when price was dropping down. If it trades up into those levels and hits a quadrant level, then you have a little bit of a loaded deal. It could potentially send it lower and reaching into another reference for sell side. So we have a wick in here. This is measuring that. So you want to have that. I don't want to take this off yet because I want to keep it on when we go into lower time frames. But you also want to use this one. Why am I using this one? Because it's the longest one in all these wicks here. See that? Even though it's longer probably by close to low, it's longer in terms of reaching lower. That's how I'm qualifying it. Okay. It's not simply the length of the wick, it's how far the wick is reaching lower. Like this one's definitely lower than that one. You see that? So it's not like this wick could be, and I don't know, I'm not measuring it, but say this one was actually, say, 2 handles longer by range than this one. It doesn't change the fact that this one went lower. That's what I'm referring to, okay? So this low and that low, what does that form? Relative equal lows, right? So there's a large pool of liquidity resting right there. But because this wick exists, you want to have that graded on your chart. And what do you think the importance of that is? You want to see it not close below this 50% level, consequent encouragement, or do you want to see it trade below that? If this is, in fact, a relative equal low that it's drawing to, it might be, in my opinion, that's what I think it's doing. But again, it's not meant for you to take as a trade device. If we get through this wick, there should be speed to close below this halfway point of that wick. And if it can close below that, then it really makes it easy that it's going to go here. But you hold on to that idea. I'm not saying that it needs to close below that for the short to be valid. It doesn't mean you have to close below here to be short first. And I'm just saying that these are all qualifiers to build confidence while price is dropping. If you're short, these are things that would build, I guess, the idea that I would be comfortable staying with the idea in the trade. And they would all be like confirmations, things that make you sleep better at night while you're in the trade. Not that I'm holding overnight when I take trades anymore, because I'm not, because too many things can happen, because I mentioned earlier, gap risk. All right, so with that, all these indentations here, okay, now we can drop down into, we'll drop into a 15-minute time frame. I gotta be careful because I want to talk a whole lot more. Do it, ICT. I'm taking so much notes. All right, so you can see right away, they use that inefficiency I mapped out on the daily chart. Look at the bodies respecting that. That's beautiful. And then we fail to get to it here, and then we leave it. We come back up, hit the high of the old wick on the daily chart. You'll be able to go back and record. Just look at the time frame right now and make a note of, go back on the daily chart and see what this level is here. But you won't need to do that if you do the same things in your chart that I'm doing. That's the benefit. You need to have it in your charts. Don't just look at my stuff and say, I'm content. He's done it there. He's done all the work. No. But use the wick high, broke lower, bearish fair value gap that lays right close to the upper quadrant of the wick. That's what these gradings are here. I told you I was going to leave it on there so you can see it on the lower time frames. So order block, upper quadrant, beautiful delivery, breaks lower, trades down to the lower quadrant, the low of the wick, and then reach down here. And then we have, hopefully, if it's set right, there should be. I don't think I have extended them far enough over to the right. I didn't. No, I didn't do it. I don't have it set to show on all time frames. I think that's what it is. Let me go out to the daily real quick. These are the things that frustrate me because I wish they would. Visibility. All right, so now we go down to 15 and 10 frame. It'll be there. There you go. So that's the relative equal lows here, and there's the earlier low. So this is high probability, and then it should speed up below that if it's ideal to get down into that sell side. So that's how I would use that information and how I would map out my chart. And the fact that we have a lower high on S&P compared to the Dow, which doesn't really say that much because again, like I said, the Dow's only 30 stocks, the S&P's 500. All right, back to the daily and NASDAQ NQZ 2025. Here's the business on that. Zoom in. Alrighty. So same idea really. We have a low. This wick is the lower between that one and this one. So you want to grade that. These quadrants could be impactful here. You want to see it close below consequent encroachment. That's ideal for it to potentially run continuously to that low. Sell side is here. There you go. And same business over here. We had that volume imbalance. I talked about that on, I think it was Monday. Was it Monday or Tuesday? I don't know what day it was this week. I shaded that it was white, and I told you it would how we use that range. It would be indicative of what we do the rest of the week. And then we traded lower. Sell side's been taken here. Next point of interest is the consequent encroachment of that wick that's being highlighted there. So it needs to close below 24,602 to continuously be bearish. That's how I would view it. All right, and just for a 15-minute time frame peak. My stomach is ground like crazy. Beautiful delivery of consequent encroachment there. Consequent encroachment of that one. Lower quadrant of this. Grade that on your own chart, and then dive deeply. Sell side there. Really nice. That's really nice. I've been sitting here talking to you. I could have been shorting NASDAQ. Anyway, what am I going to do? What am I going to do? It's never going to work again. I missed it. The last bit of business I want to talk because I gave you a lot today. Okay, so I appreciate if you guys don't come at me for rushing through the portions I've done. Just the discussion while we were on the dollar index chart, the things I taught you there was worth your time being here today. I believe, and that's somebody with 33 years experience. But let's go to the daily chart and look at let's look at stocks just for a second. How might this be useful for stock trading? I have a lot of questions that come to me by way of that. I do a portion of teaching in the 2017 portion of the paid mentorship where I talk about stocks and whatnot. This is kind of like a different approach to a lot of the things I talked about there. So in other words, kind of like an amplification. So charter students will appreciate this because they've been able to be trained by me with the stock trading side of it too. But let's pull up. I don't know. I haven't traded stocks in a while. Let me Facebook. What's their symbol now? Some weird name. I don't know. What is it? It's not Facebook. What is tweet to me? I'm here live here. I'm struggling here. What is Facebook's stock symbol now? Quickly, quickly, quickly. Somebody knows it. Come on. Somebody knows it. Meta. I think this one is Meta. Meta. Right? Meta. Right? Ooh, that is an ugly shirt, ain't it? Meta. Meta platforms. All right. You guys confirm that? Yeah, Meta. Thanks, Ryan. All right. So right away, you can see that this is a heart attack for efficient delivery and price action. And this is one of the things I learned when I was trading Globex as a commodity trader. And Globex would be very, very spotty. And spotty is like this, where there's a whole lot of areas where there's gaps, real liquidity voids. Okay. So the way you clean this up, first and foremost, is first look at it. What do you see here? Let me zoom in here. And this is beneficial even if you don't trade stocks, okay? Because there's going to be times when you're looking at price action that it can get spotty. If you're a commodity trader, you'll see a lot of this, okay? And I'm going to show you the easy, simple fix. Very, very simple, and it gives you clarity, okay? But here's the daily chart, and it's extremely, very spotty. Can you imagine being up here? You went long here, and you're holding up here thinking, wonderful, man, this is so good. Thank you, Zuckerberg. What? What? What just happened? That's a haircut. That's a haircut, okay? Now, what do you think happened here? I mean, looking at all this stuff here, I mean, wow, that's problematic, isn't it? Like, who could have known that was going to happen? I mean, what can we do? What can one do? Well, you're on a daily chart, number one, so you're gonna have to come up. So what would that be? You can do a 2-day chart, a 3-day chart, or you can just jump to the classic 1 week or weekly chart. So you can go to a weekly chart and boom. Now watch the magic. Why? Now, for the folks that are brand new and watch me doing this for the first time, yes, yes, I'm outlining it in hindsight. I don't trade stocks, but I do this all the time with NASDAQ. I do it all the time. And I did it for years in the presence of thousands and thousands and thousands and thousands of witnesses that were paying me. And if I wasn't doing it live, they would have crucified me. Okay. I've earned the right to be able to talk like this. I'm teaching you how to do it so that way you can do it. I can do this. I don't need to do this stuff. Old high, that's buy side liquidity. Okay. So it rallies above that. When it makes this run higher, see that right there? Volume imbalance. Look how much cleaner price action gets, and it becomes far more predictable than using that daily chart. Why anybody's trading stocks using a daily chart right now is beyond me. Okay. The volatility is off the chain. It's been like that for a while. So you have to have a perspective that's linked to a higher time frame chart. This is where smart money is operating. They're not using daily charts. Look at that daily chart before we went to this time frame. It was a heart attack. You don't know where you're at next. It's opening and closing and opening and closing. Way huge, hundreds of points difference. If you're holding 5,000 shares of Meta, I mean, maybe not some of you doing that, but there's people that are doing that. And you're holding overnight, and you're getting a haircut of 100 points. Wow, like wow, you're getting crushed. But now suddenly, when you see this volume imbalance, same premise. Okay, watch what happens. What we just described when using the volume imbalances on price action. I'm just trying to thicken it up so you guys can see. The volume imbalance, you want to carry these through price action. Sell side deliveries offered. What is it now short on? It's inefficient in what? Buy side delivery. That means price moving back up through this imbalance. So this area here that's highlighted, it's missing both buy side and sell side. Even though that wick is there, there's no bodies in between the opening and closing of that candlestick right there. So by having it extended through, you can see sell side is offered there. But now what is it missing? Buy side delivery. It happens here. The candlesticks are laid over top of that. See that? And then now we leave it, we close below it. Take your reference point right back to that layer right there. That's where it's going to trade up to. Smart money's going to go short there. Same thing I just described in the indices, same thing I described in the dollar index, same thing I described in the Forex market. It's the same thing, folks. It's the same logic. Each one of these instruments have an algorithm that is running with the same logic I'm teaching you. Period. If it didn't, it wouldn't work. I can't take you to a room or a place or a person and they're going to come and be interviewed and say, yes, what he's saying is here's the thing, here's the this. No, it's a simple observation of it's controlled. Now you can get upset about that because you've subscribed to the idea that it's buying and selling randomness, which makes no damn sense to me. Why anybody would ever risk money on something like that? That's like horse racing. How do you benefit from not knowing anything about the other horses? You just have a strong affinity for how well that horse was raised and that jockey won races before. So therefore, it must be a sure thing. Wrong. It doesn't have any basis on the future outcome of that race. So having the criteria that repeats in all instruments, that means it's algorithmic. It's looking for inefficiencies. It's looking for a balanced price range. That's what a volume imbalance becomes when it sells off and lays bodies over top of it. Now it's only what? A SIBI. Then it becomes a fully delivered buy side and sell side delivery when the candlesticks trade back above this range. So it's like that paint roller analogy. There's no paint in here because there's no bodies. The roller comes down across it. Both of these candlesticks bodies are now painting over top of that gap where no paint was when your partner painting the wall missed it. And you came behind him and said, well, I'm going to fix this area because he didn't do a good enough job. I can see some of the wall still. Paint down. And then now to make sure it's ample paint distributed to the wall is framed by these two price points, the candlestick's opening, that candlestick's close. The paint roller being applied to the upside now efficiently delivers the paint. So now this area is become a balanced price range. So if price can manage to get through it, it's going to be real hard to get back above it. And what do you see here? It opens, wicks through it, not through it entirely, but up to the high of it, right? No, it can't get to the actual high of it. And then went back down below that opening price. If you can get into it there, that's where you short. Stop above here. That's pretty painful. That's pretty painful. Why did it go down here? What is this? Watch. Volume imbalance. Now, what is it doing? It's providing what? Sell side delivery, not liquidity. Delivery is the action of applying candlesticks into a range that is inefficient. Sell side delivery is the movement of price action directional going lower and being printed in candlesticks that are moving continuously lower. Once you define an area like this volume imbalance, I don't want to do that. I want to stop it right there. That candlestick's close and that candlestick's opening. That's the inefficiency. As price is dropping down, it's doing what? It's delivering sell side delivery. Once it goes down to the low here and a body is dropped on that low, then if it trades back up, if it makes its way back below and leaves this low again here, this will act as a balanced price range. In other words, it's going to be very stiff, real resistance. Now, contrast that with supply and demand, or contrast that with classic support and resistance. That's not explained that way. That's not explained like that at all. That's why I'm trying to tell you, when you listen to these people on the internet or you read them and they talk out their ass and say that I'm telling you something that's rebranded, that is not anywhere else. That's what I tell you to go out. If you find what I just explained in support and resistance, supply and demand, Elliott wave, Wyckoff, Gann, whatever, find it just like that in a book before 1996 or in a video documentation where I can find it in circulation because I got tons of stuff, folks. I got stuff that's been out of print for decades. I promise you, there is nothing before this. And if you could, it's $5 million, and I'll drive it to your house in a bank check in a diaper. You can videotape it and record it and put it on live stream when I do it. But it's a safe bet because it ain't never going to happen. You can't find it. So again, for the piece of people that say, why do you even respond to these people? Because AI is watching everything that I'm doing and what you're doing. And because I'm a public figure, the bad information that's being sowed out there is for that purpose. So that way, when you do ChatGPT, or if you go on to Reddit, or if you go on to Grok, the only information that those things get is when it goes out in the internet and does the same thing a Google search does. Google search. You think that I lived in a welfare development. You'd think I was broke and living behind a McDonald's if you believed everything these people said. But because they say it, because they put up stuff that ain't real, they twist facts. Having rental properties is not me living in houses like that. Okay. Big difference. Okay. Big difference. Long story short, this potentially could go lower, and I would like to see this be used as that same catalyst here. It obviously it would be better if it just kept on going lower. But if it goes below this area here and come back up, it needs to stay in the lower half. It can wick through it, the halfway point. Let me darken that up a little bit. And there you go. So if it trades below this rectangle area, okay. Big shout out to the guy on YouTube trying to sell his mentorship, but it's really my stuff. We trade boxes. No, it's a fair value gap. That's what it is. Okay. But when you trade below it, come back up, it needs to only keep the bodies in this portion, the lower half. It can wick up in here, but the bodies need to stay in here. And as long as it does that, and that's again assuming that we close below this area. Any new candles that form, if it trades back up in here, I'm not going to freak out. I would expect it to do that. And then reach lower. And there's sell side here, here, and here. So, worst case scenario, this thing could trade down into the 400s. But that's assuming a whole lot. I don't have any skin in the race. I'm not short. I don't have put options. I don't trade stocks. I'm not touching them. I'm just giving you an application of how what I do in Forex, what I do in index futures and commodities, currency trading, bond trading, everything is actionable on every instrument. Every instrument. And I gave you examples with Bitcoin simply because I'm pressured by my long-term students and I don't want to be disrespectful to them because they've been very patient in asking. Long-winded rants about everything else and them saying, you don't ever answer our questions when it comes to this. So I did it. Okay. So please leave me alone for a little while. Give me some time. Okay. But I don't want to subscribe so far with the things that I teach as it relates to crypto. I've never traded it. I've never made any money with the crypto market. So I can't stand behind my word with that, but I have made money with everything else. So I want you to know that there's a difference between when I say something, I can stand on it because I've made money doing it. If I don't make money with something and I've never traded it, why would you care about my opinion? Can we agree about that for a second? Just be honest, okay? If I've never made money trading an instrument, why would you care about my opinion about it? I haven't validated my opinion. Because if my opinion held weight about that instrument with my own faith and money being risked on it, then I would have what? I would bring forth receipts. I would be trading it. I would be giving you examples. And here you go. I've done this and done that. But because I've never done it, that's why I stay away from it, folks. That's why. Can you appreciate that honesty? Can you at least give me that? That's all I want you to understand. I've never traded in it, and I don't ever want to trade in it. Okay. So that's why I don't touch it. I believe it's going to be used as a something that's painful for people. And I don't want to go into a Bible study here, but that's exactly why I don't want to touch it. Okay. Could I have made a lot of money trading it? Yes. In 2013, I could have bought it in the hundreds. I could have done all that stuff. I could have bought it when it was down at 3,000. I could have done it at 6,000. I could have done it when it was 20,000. I told you when it was going to go to 20,000 for real. I told you when it wasn't going to go to 20,000 and it tanked down to 3,000. Go back in time. You see all these people saying, you said it went to 3,000, you were going to delete your channel. Because I want all of you crypto people that are fanatics to leave me alone about it. I'm not going to spend time looking at crypto markets because I don't have any vested interest in it. And I don't want to inflate the interest in other people because I don't have faith in it. Do you understand? Like that's the real issue here. I'm afraid it's going to be used to hurt people. And I don't want to have any affinity placed on it to where you look at me as an influencer and say, he enticed me to do this and I lost money. I don't want that. I don't want that. If I don't see any reason for me to get into it for my own money, I sure as hell am not going to try to talk about it and inspire people that just take everything I say just because I said it. They believe it's the truth. When I'm telling you, don't believe anything I'm saying. Go into the market and see if what I'm teaching holds water. If it doesn't, then you've exposed me and then move on. Find somebody that does a better job than I do. How hard is that? That's what I would be doing. That's all I ask you to do. Okay. You'll get your own evidence if you look for it. But if you take your opinions from other people and you think that you're informed or I didn't never get scammed by that ICT guy watching his free videos. Woo, you really saved yourself, didn't you? Unless you've done the work and studied it yourself, you don't know. You're taking the opinion of a nobody that you never met before, and borrowing their logic, which is what retail does. Think about it. Retail looks at things that have absolutely nothing to do with price action, not one thing, but they subscribe a religion to it. That's what it is. It's a religion. Retail is the real cult. Look how crazy they are when I come out and tell them their stuff is garbage. And they come at me all the time, and I'm still here. I make fun of them. I laugh with them. Oh, man, great. Whatever. But they're ready to murder me. They want to come by my house. They want to do this. And, well, if I ever catch you in the streets, man, you don't want to catch me in the streets. Trust me. You're going to catch these hands, and you don't want them. Point is this: keep your emotions out of this. Because if what you were doing was making you real money, you wouldn't care what anybody says. Because I don't care what anybody says about my stuff. And my stuff is the best. It rules. It reigns. There is nothing better than it. Nobody's came forward and beat it. No one's ever done anything better. No one's more precise, and they can't come close. And that's the confidence. It sounds like arrogance. It sounds like it's narcissistic, but that's because you're on a lower plane of understanding and you're looking at someone talking from a perspective that's way higher than yours. And it doesn't mean I'm smarter than you. It doesn't mean I'm better than you. It's just that I'm subscribed to a view that the markets are really, really rigged. And I look at it through that lens, and I'm not falling victim to the same things that retail traders do, whether it's volume profile, footprint, level two data, supply and demand, Wyckoff, Elliott wave, Gann, Fibonacci on the basis of how Fibonacci is used. I only use it for basing a quadrant in an equilibrium. That's it. That's it. That's all I'm using it for teaching purposes. So that way you as a student can find your entry technique with that given level, not some random zone. I don't deal in zones. Okay. It's very specific levels. And I hopefully communicated that with you here. And I guess you'll let me know on X and in the comments in the video whether or not you learned anything from us today. I've had fun with y'all. I had a wonderful time teaching you. And it's time for me to grab something to eat. And I hopefully did a good job with your time invested in me today. Until I talk to you next time, have a pleasant holiday season. And until I talk to you otherwise.